Nick, yes? That's not good.
Here.
Catherine Allen?
Here.
John Bingaman? Here. Kelly O'Donnell?
Here.
Alan Sanchez?
Present.
Kurt Sommer? Seven members present, we have a quorum.
Agenda item 1B, approval of the agenda.
So moved.
Okay, do we have a second? Second. Do we have any discussion on the motion? Hearing none, if we could, do we need a roll call vote? Any objection to passage of the agenda that is? Hearing none, the agenda is passed. We'll next go on to approval of the minutes from our September 24th meeting.
Approval.
Second. Any discussion? Objection? Okay, we have passed our minutes, and we'll move on now to agenda item 2A, and hear from our state investment officer.
Thank you, Madam Chair. Good to see you all this morning. I know we have a lot ahead of us, so I'm going to make this brief. As of this last Friday, our net asset value is still hovering a little bit over $58 billion. We are currently trying to fill 4 positions. A couple we're working on the job postings. One that we are about to post, it is our marketing and website manager. I had mentioned previously we're planning to do a significant website overhaul, and this person will be overseeing that effort. And then we are in the process of extending an offer for another position, an analyst for the risk and performance team to support our risk officer, Nina Carpenita. We had our LFC budget hearing this past week. It went really well. It was great to see the level of support from LFC staff and committee members. One thing that I was glad that LFC staff noted during their presentation was that over the last 15 years, the amount of assets under management have about quadrupled, and until this year, our staffing actually has remained completely flat, and now as of this year, it is up 5 compared to where it was 15 years ago. There were a lot of comments from the committee members that were very supportive about trying to properly staff our organization and make sure that we have the resources that we need to appropriately manage the $58 billion. With that, Madam Chair, I'm happy to answer any questions.
Madam Chair, on those positions, what pay band are they, the salary range?
So, Madam Chair and Treasurer Montoya, the marketing and website manager is going to be a governor exempt position. I'll have to find out what pay band that is. The other 3 positions are all going to be the pay band of our analysts and strategists. I believe it's 95 to 95.
What range is that?
Madam Chair, Treasurer Montoya, I'll have to get back to you. I don't have the exact range. I'll have to find that out and get that to you.
Pay band 95 is over 6 figures, so correct?
It can get over that high, yeah.
And Madam Chair, on the last budget, I think we got approved for 1 extra staff for this last fiscal year, is that correct?
Madam Chair, Treasurer Montoya, the legislature gave us an additional 6 positions. They're taking us from 31 to 37.
Thank you. Further questions? Hearing none, let's go to agenda item 2B and hear from our chief.
Well, thank you, Madam Chair. Good morning, everyone. If we wind the clock back just a little bit to the beginning of the year, we were talking about how this year might play out in terms of markets and the economy, and it's pretty much been in line with what we were expecting. Stock market did a little bit better than we sort of thought it would. It's it's that year into the presidential election, particularly when an incumbent is running, and at the time we were talking about that, an incumbent was running. That is always okay. But normally we get a little bit lower volatility, we get a decent stock market, interest rates remain pretty stable, the Fed generally stays out of the mix, during that period of time. And all that's come to pass. We've just had a little bit better performance in the stock market as compared to that expectation for the year. Now, short periods like that, we don't really make any investments based on, but it is good to have sort of some short-term expectations. For performance through June, and we'll take a year or so back, so half of calendar 2023 and the first half of this year, there's been a lot of spread in performance. Mainly because it's really only been the stock market that's performed so well. Most other assets have been pretty tame, and you'll be able to see that in your performance report when we get to RBK. So some of the big university endowments, Yale reported their June one year number, their fiscal year number, at 5.6%. Princeton was out at 3.9% for that year through June. But on the other side, some of the most U.S. equity exposed public funds reported as much as 10% in return. So big spread in returns across the board. Of course, we came in at 8 for June. A good number relative to our policy benchmark, above the policy benchmark, and also a good number relative to our long-term expectation of 7%. So even with the additional cash and bonds that we've got on most funds' balance sheets, due to the high inflows, still a pretty good return number. The economy performed, actually we're hitting 3% on GDP, which is above what we would expect. Our long run growth rate here in the United States anyway is about 1.5, maybe 1 3/4. If you look sort of 10 years, 20 years into the future. So well above trend growth so far this year. Really holding the economy up as far as we can tell, and we've dug just about as deep as we can, has been federal government deficit spending. So federal government right now is spending 6% of GDP in deficit. So expenditures less receipts amounts to 6% of GDP. That's a huge number. There's been recessions that we've gone into where the federal government only spent 3% of GDP to get us back out. So 6% is a huge number, and there doesn't look like there's any fixing coming in the short run. If you look at some of the proposed policies that have been coming in. So we're keeping our eye close on that. When you talk to people, and there's some really good surveys, the best one probably is the Michigan Consumer Confidence Survey. They've been doing that for decades and decades, and they're very, very good at it. People pretty much say we're in recession. At least they feel like they are. And in fact, the level of the Michigan survey is below where it's been when we went into recession since about 1959. So very low Michigan confidence survey. So really, it's been that deficit spending that's really held things up. Also, in terms of income, interest income in the last GDP report really got revised higher. That makes sense. Interest rates are higher. The problem is most interest income accrues to the higher income brackets. So the folks that make a little bit less are much less exposed to interest income as part of their total income. So we're keeping our eyes open here. I still feel like we're positioned well with a little extra cash and bonds on our balance sheet. Like I say, the highest returning funds in the year ended in June are very dependent upon the U.S. stock market, and we know how high priced that market is, and volatile as things do turn down. The last thing we'll say, Madam Chair, is we've got some longer run concerns. Those are in the annual investment plan. So keep those in the back of your mind. Deficits, demographics, a few other things that are in the annual investment plan as concerns. Keep those in mind because we watch every day in the markets and the news to see if those trends will when those trends may start to play out. But for now, I think we're well positioned, and I've got my comments off there, and maybe come back in when RBK has performance.
Question?
Chair, we had a good meeting last week. We had a quorum for the meeting. We unanimously recommended each of the voting items to the council today. We also had a discussion about the investment policy statement update and provided some suggestions to staff on that. So, all in all, a positive meeting, and thank all the members.
So now to your performance report from RDC, agenda item 2.
Great, thank you, Madam Chair. Good morning, everyone. Today, we have your August performance report in the packet. And as always, we'll start off on page 21, which is the performance summary that you're familiar with. I think as you look at the market performance on the bottom right-hand side, you can see the month-to-date performance essentially reflecting August performance, and then next to that, quarter-to-date. That includes both July and August for the first 2 months of the third quarter. Overall, another good month, building on a strong July. We've had a number of good months that have contributed to the strong returns that you're seeing, both on a calendar year-to-date and a one-year basis. Been talked about strong equity markets as we've gone further into this third quarter and into October. We touched on market record highs. So we're certainly highly valued, but have enjoyed strong returns out of those equity markets since then. Looking at just the monthly numbers doesn't tell the full story. There was quite a bit more volatility that started in the first part of August. There was some repricing of the equity market due to softer economic readings. And when valuations get to this level, they obviously become more sensitive to readings that come out. And so the readings are good, markets are going up, but on the flip side of that, when readings are falling short of expectations, they react quite materially. Fortunately, in this case, most of those fears subsided in the second half of August, and most of the markets pulled positive by the end of August. You'll notice that the Russell 2000, which represents the small cap index, had a bit of a negative number, but that's coming out of a July that was up over 10%. So really, when you think about that, in terms of a multi-month period, still very strong returns. The dollar is still a bit high on a historical basis, but has weakened on a relative basis, and we see that in part is contributing to some of the stronger performance in the non-U.S. markets as those foreign earnings are converted into dollars on more favorable terms. Emerging markets is starting to pick up a bit as well. That's been a laggard for quite some time, and so having that global equity exposure is starting to pay some dividends, where for the last decade or so it's been all U.S. equity for reasons that we've talked about. Interest rates we spend some time on the top right-hand side, you can see that. Blue and green lines just compares it month over month. Not a huge move, but interest rates did move down. The yield curve is still inverted. That's continued to come down. And most of that was due to expectations that the Fed would cut rates pretty aggressively, and that has been built into those expectations. We now, of course, know that it did lower 50 basis points, and those types of moves in terms of interest rates coming down really benefit any asset that is duration sensitive or has exposure to interest rates, mainly fixed income, real estate, assets with close ties to interest rate movement. So those benefited quite well. I think you'll see that as part of that, fixed income is picking up 1.4% for the month, and through the quarter, so this is taking it all the way to the end of the third quarter, fixed income was up over 5%. So again, obviously you can't annualize that number, but that's a pretty strong quarter. Typically, you would expect that out of a full year. So we have seen rapid moves up in rates over the last couple of years, and as those come down, you see the other side of that. Overall, as Vince said, diversified portfolio positioning that you do have is appropriate and prudent. It needs to serve you well through a full market cycle, both on the up and down, and we think it continues to make sense going forward. Marcia's going to spend a little bit of time talking about the portfolio results.
Let's take Marcia and then we'll go. Good morning, Madam Chair and council members. Brent, you're there. Page 21. page 23 of your diligence. At the top on the right-hand side, you see the allocation. Stepping back, this is an August report, and just as a reminder, private equity, real estate, and real assets show zero returns on inter-quarter months. So this is why we focus more on the quarterly reports. You have truer numbers of these folks in privates at zero on those months. So that's one reason why we'll be pretty quick here. But looking at the allocation on the right-hand side, we're showing land grant and severance tax. For any a fund that has an interim target, we show both the interim target and the long-term target allocation, and that's shown for both the land grant and severance tax fund here. Performance is shown at the bottom. And again, this is as of August. You had a strong month, up 1.32, and calendar year to date, you're at 6.67. 1 year, you're at 10.47 for the total fund. That includes for all assets that you're for all the funds for which you're responsible. You can see that the land grant was up for the 1 year period, up over 11%, and the severance tax is up 9.27. So all in all, you can see good outperformance relative to your benchmarks for those two funds. Pages 6, 7, and 8 show the same information we showed for the land grant and severance tax, where we show you versus your long-term targets. If there's an interim target, we show you against both. So that's just for your information. I'm going to take you to page 27. And this is going to calendar year, but it's noteworthy. The top is looking again at the total fund. All the funds for which you're responsible are in this number. But what's remarkable is for this calendar year, you began the year at just over $49 billion. Grew net cash flows plus returns over $8.2 billion calendar year to date, which puts you at the end of August almost at $57.5 billion.
Is that a record or no? Of the 1 year growth?
I don't know, but and this isn't even a whole year. This is calendar year, so we can look at that. Just remarkable. I just wanted to point that out. So then you can see down below all the individual funds. Most have net cash inflow or positive cash flows. Some have had distributions, only one, I guess. We do show performance for each of the individual funds, but I thought I'd go to page 30 and just talk about the composite performance. And again, we won't be looking at real assets or private equity or real estate because they're held at zero on this interim quarter month. But showing at the top land grant and severance, we've looked at those before, but looking at your U.S. equity composites, slight underperformance relative to its benchmark for the month. But remember, this is mostly passive. You can see outperformance through the 3 year where the portfolio was repositioned. I think Greg is going to be looking in 2025 again at structure for the U.S. equity composites, but Century structure mostly outperformance. Non-U.S., which you did recently do a structure study, see across the board outperformance against its benchmark, and up a non-U.S. equity composite up for the month more than U.S. equity composite. If we look at fixed income, short term, you had slight underperformance due to the short duration assets in the portfolio, but longer term you can see a solid outperformance against your benchmark. Private market, fixed income, I know we talked about this, but you are restructuring that portfolio, building that portfolio. You changed the benchmark of that portfolio so you can see a shorter term underperformance against your newer benchmark. But again, that portfolio is in transition. Just pointing out that cash, the 1 year number for cash is 5.56. Calendar year to date, cash has been at 3.74. If you go to page 31, the only I'm not going to go through the privates, but I did want to show that at the bottom you can see your economically targeted investments, which are benchmarks against the T-bills. I know that we moved this up forward in the report because you you wanted to see that, that number. Lastly, on page 33, just looking at where your performance came from, and this is looking for the one-year period ending August. Obviously, the primary driver for your returns for that one-year period, as it typically is with the asset allocation, you returned the land grant, returned 11.05. The benchmark was at 10.52. So how did you outperform? Well, if you look at the far right-hand side at the bottom, you see the outperformance came for this one-year period from manager value add. So manager performance was very additive for that one-year period. If you look towards the middle and you see that TAA, that just is, are you at your target allocation or your interim target allocation as that applies? And that was a slight negative for the land grant, 30 basis points for the year. And also asset class structure was a slight negative for that one-year period, mostly driven by, again, that private markets, which is in transition. And with that, Madam Chair, we're ready for any questions.
Madam Chair, if I could, just one comment. So back on page 25, Brent, so I know the treasurer asked about this a good bit. Where are we relative to our interims and long-term targets? So we've got 12 funds. 4 we're not there yet. That's land grant, severance, early childhood, and higher ed. 5th is a tobacco fund. I think we can get it there in the next 3 months with long-term targets. And the other 7 are there. So we made a lot of progress over the last 9 months probably in getting funds to their long-term targets. Still a good bit of work in that first group, land grant, severance, early childhood, higher ed. But we can get tobacco there in the next 3 months and everybody else is there.
Madam Chair, if you look at my notes, that's exactly what I was thinking. A lot of work. That's great that you guys are getting closer to that area. The only thing I would ask is, based on where we're at today, based on what you mentioned earlier, based on the idea that the potential that we're in inflation, are we still, or should we still be targeting the same asset allocation that we had before? And let me add to that, on the idea of looking at how much we've made now versus the risk we're taking. Does it equate to keeping that same amount of risk, or should we shift because of the fact that we're in a certain market we're in right now?
Right. So Madam Chair and Treasurer Montoya, we spelled it out as well as we could in the annual investment plan. We just think, we haven't had a proper recession since 2008. Government, the government portion of the economy, you look at economic studies and things, anywhere from 11 to 17% is a good level for a government as a percent of the economy. It's 36% today. We're running 6% GDP. We're in a crazy position here. So it portends that things are going to get a little bit rougher down the road. And so the best way, historically, the best way to handle it is to go in very diversified, own a little bit of a lot of stuff. And that's exactly what we do. So we really boosted up things that will do better if we do get some inflation. We've got our bond portfolio will do great if we slip into recession. The rest of the markets are going haywire and interest rates are falling. So we've got a very diversified portfolio. So yeah, I think we hold our position here. And like I was saying at the beginning, some of our very U.S. equity exposed peers earned 10% in the period. We were at 8%, so we hung in there pretty good. Sort of a one-trick pony market. But you can, on the other end, is the big endowments which aren't exposed to publicly traded equity, very little in the U.S. They were in 4% or 5%. So I think we're just in that kind of a market where there's a lot of risk, and the diversification that we have is really the way to go.
Chair, as it relates to diversity, what is the percentage of the $57 billion that's with emerging managers?
So I think we did a report on that. I don't know off the top of my head, Madam Treasurer, but I digged into that report.
Is that the same report that you gave us on the less than 1% in private equity that same day? Or are you talking about, I'm sorry, is that the DEI, or is it, or just in general, emerging managers?
talking about diversity, we're talking about it being volatile, we're talking about making sure we put a lot or a little bit in each of these buckets. So I'm just curious how much of it is in emerging markets. A lot of times, or in emerging managers, sorry. The reason why I ask is because a lot of times emerging managers, or even people with DEI, especially in inflation or in times of crisis, are much better at handling crisis. So I'm just curious how much of that, of the portfolio we have in that bucket.
We can update it. We provided it on DEI, and it was a small percentage. We have not looked at the managers to see if any of your managers are actually emerging managers. We can do that.
I think it's a good idea, and I will say for sure 1% is not diverse in any kind of way that we look at any kind of number. We definitely need to work on that a little bit more and look at our process. Thank you. Other questions? All right. Move on to our voting items. We're going to take first agenda item 4A, private debt, orchard, elegant tree opportunities, master fund 3, Mr. Lawson.
Madam Chair. First off, I want to say that I think on Tyndall for my service, I can't type, so this is a game changer for me. Thank you. So this is a recommendation in consultation with Makita for $150 million commitment to orchard elegant tree 3. I have here with me today Mary Bates from Makita, John Young, who is the Chief Investment Officer for Orchard, and then Michael Hidalgo, who would be our primary relationship overseer at Orchard as well. At the credit committee, Mateus had to sit through a rather long speech by me explaining the whole history of these types of risk transfer arrangement, so I won't go through that again. I'd just like to broadly talk about portfolio fit. From the standpoint, when we first came to, there was a lot of mention earlier about the private credit portfolio being in transition. From the standpoint of when we first initiated all the structural changes in private credit, one of our key goals was we wanted a portfolio that primarily gained its returns in income returns over price returns, and we also wanted the ability to improve the ability for reinvestment income, because we're a cash-rich plan. We wanted the ability to keep our money invested as best we could. But when you look at the whole risk spectrum that's out there that you can go into, I put a chart in the original structure study, sort of explaining how we wanted to end up, or how I wanted to end up structuring the risk within the portfolio. And essentially, as you go higher in risk, you're going to go lower in duration, and as you go lower in risk, we're going to be more when you go higher in duration. So this is a strategy risk transfer arrangement. You should broadly think of them as insurance contracts or insurance arrangements. So just like the insurance on my house, I pay a monthly fee in return for that option, eventually getting paid if there's loss. Similar type of it's a running type thing here. But with that, you get paid back over a longer term. So while the target IRR for this strategy, 11 to 13% is good, ability to have a high multiple on this type of strategy since you don't get a lot of your income upfront, lower. But this is a lower risk part of the spectrum. So as we're trying to generate or create a portfolio that's a nice diversification, as Vince said, between higher price return strategies, higher income return strategies. This would fit in the higher income return strategies, lower risk strategies overall. So that's kind of where this fits. With that said, I'm going to turn it over to Mary to talk about the actual strategy itself.
Great. Thank you, Tom, and thank you to the trustees and to the board. I'm going to keep my comments brief as always because we are joined by the investment managers. But for background, Orchard Global is an alternative credit specialist. They were founded in 2008. They currently manage approximately $8 billion of assets under management and have over 140 investment professionals. They are a privately held investment firm. In terms of the strategy that we are focused on today, again, as Officer Lofton mentioned, this strategy is focused on regulatory capital relief or significant risk transfer, terms that are often used interchangeably. So what the strategy is focused on is providing capital relief to large regulated banks and other financial institutions. With respect to this strategy, the manager is focused exclusively on globally systemic important banks in the U.S. and Europe. That is to say, they are not focused on smaller regional banks. In terms of the underlying collateral, they are focused predominantly on corporate credit, including corporate revolvers. This is a highly diversified strategy at the underlying loan level from a transaction basis. Expect 12 to 20 transactions. The Senator, or Officer Lofton, noted you. References to the yield-focused strategy. So this is a SOFR-based strategy, so a floating rate strategy typically, plus a spread typically of 600 to 1,600 basis points with a weighted average life typically of 3 to 4 years. As I typically do, I'm going to transition and focus predominantly on the strengths and weaknesses as it relates to this strategy. So what we identified why we support this manager is they're a long-established investor in the SRT space. As mentioned, they've been active in this space since 2008 and have executed over $5.5 billion of capital across 60 transactions. We have a large established team focused on this area, and we're joined by one of the principals of that strategy, the Chief Investment Officer. This is a flexible strategy that focuses on banks' core lending activities, which we view as attractive. We also, as I alluded to previously, there is diversification at the underlying level. Some of the concerns that we would identify as it relates to this strategy, and I know that the treasurer is not in the room currently, but there is a low GP commitment relative to other strategies, relative to other funds in the market. So you may want to address that in greater detail with the manager. They would highlight, of course, that a high percentage of their personal net wealth is associated with that. As with all of these strategies, credit impairment is the biggest risk associated with that. We would point to the manager's track record as a proof statement on their ability to execute, which has on an annual average realized loss ratio, and we would highlight that we focus more on losses which are realized rather than on default. It averages out to approximately 4 basis points. So with that, I'm happy to take any questions or determine.
Thank you. First of all, thank you for having us here today. My name is John Young. I'm the Chief Investment Officer of Orchard Global. I'm joined by my colleague, Mike Hidalgo. I would just say we are a global credit manager. We've got offices everywhere, including Houston, but we also do have New Mexico roots. Both Michael and our CEO grew up in Albuquerque, and so obviously still here a lot. As was said, this is our fourth fund in the space. I think as of now, we've invested about $7 billion in capital over 80 transactions, the majority of which have had no defaults. and those have typically has outperformed our underwrite. And so we have a team that focuses on due diligence in the banks, structuring the transactions, and underwriting the loans. Most of our loans are in the public domain, and so we can track them, we can monitor them, and then we can obviously make sure that if there are defaults, that they're being worked out correctly, and we can verify that as well. As I said earlier, we really focus on contractual cash flows, so we make our money because people do what they say they're supposed to do, just pay us back. All of our funds have been structured the same. I'll just say on the GP commitment, we individually commit, and when you raise a $2 billion fund, 1% ends up being a lot of your personal net worth, and we have other funds in this space, and so we do remain committed to it. All of our portfolio managers are invested in it as part of their long-term compensation. And with that, I'll be happy to take.
Hearing none, do we have a motion? Okay, we've got a motion by member treasurer, yes, based on the recommendation of the council's investment committee, advisor Makita, SIC staff, and general fiduciary oversight from RBK, I move that the state investment council approve a commitment of up to $150 million orchard Volume Tree Opportunities Master Fund 3, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiations of final terms and conditions, and completion of appropriate paperwork. Okay, we've got a proper motion by the treasurer, second by our investment chair. Any discussion on the motion before the council? Hearing no discussion, if we could take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
7 in the affirmative, motion passes.
Thank you. Thank you all for being here.
Thank you. Kurt Starr is joined us.
Oh, okay. Kurt Sommer?
I vote yes. Yes.
Okay, thank you.
All right, next we're going to hear from Director Sable on Fairfield U.S. Multifamily Value Add Fund 4. You need a bigger room. Director Sable, take it away.
Outstanding. Thank you. Madam Chair, we're here to make a recommendation for a commitment of up to $300 million total, split out $200 million to Fairfield U.S. Multifamily Value Add Fund 4, and up to $100 million in a related co-investment vehicle. This is going to be a new investment relationship for the SIC. Fairfield is a San Diego-based vertically integrated real estate operating company that began operations in this current form in 1997. They currently manage about $10.3 billion in AUM. Fairfield's strategy has focused on acquisitions of Class B and C properties in high-demand markets of the U.S., accompanied by some amount of new development when market conditions allow. Current market conditions would suggest that the value-add component of the strategy will not include the development portion, at least in the early days of the strategy, but up to 35% is allowed under the LPA. Fairfield pursues properties in markets where the properties are characterized by wide gaps between BC strata of properties and A property rents, where the objective is to perform light value-added activities and common area improvements in order to improve the competitive positioning of those assets in the market. The return objectives on the strategy are in the low to mid-teens net. Since the fund family has launched, the performance has been extraordinary, particularly over the last 3 vintages. Pre-GFC launch vintage that focused on development was a somewhat weaker performer that did only manage to return capital. Since that time, they've managed 3 much larger funds with top quartile performance, actually first and second quartile performance across both IRR and MOIC. The co-investment program is a new endeavor for Fairfield. We spent a lot of time in the diligence process around the investments that are intended for inclusion in that program. Those have already been identified, so it's not a blind pool proposition. All of those deals in the co-investment program are underwritten to the high end of the strategy ranges. In terms of analysis of that investment idea in the co-investments, looked at all the performance of investments that Fairfield has made historically. We stratified those by deal size. Generally found that their larger deals were among the better performing ones. 70% of the capital that's intended for inclusion in the co-investment program also fits in that high-performing strata from a historical perspective. So another reason why we're constructive on that co-investment pool. Fairfield is a little bit of a unique proposition for the SIC in that 99% of the GP and the operating entities are owned by CalSTRS. The alignment in the strategy, we believe, is strong. The structure generally mirrors what you would see in many of the other large platforms, but this is unique in that it's owned by another public plan. The share of carry, for example, is in line with other large platforms. One of the advantages we see in this particular structure when we're looking at Class B and C properties in the portfolio is, I'm sure many of you are aware that the headline risk associated with investments in that space can be relatively meaningful. We think the fact that CalSTRS owns 99% of the manager, is the largest investor with Fairfield, creates alignment from the sensitivity to those issues. And so I think maybe I'll pause there. Over to Rob.
Sure. Good morning, everybody. Rob Coaches with the Townsend Group. Townsend's had investors with Fairfield for better than 10 years. Good, solid platform, over 1,300 people. You'll hear the whole story from the team here. And one of the aspects we like about the platform is what we call a vertically integrated firm. In other words, they do all the real estate services in one house. So oftentimes when you invest with another firm that we call an allocator, they allocate capital out to a partner like Fairfield, and that results in extra fee sharing and extra profit sharing, which cuts into the investor's net return. By using a vertically integrated firm like Fairfield, that means more profits are available to distribute to the LPs, such as you. Again, it's a substantial firm. Keith went over the performance. It's been really good since the global financial crisis. And over $40 billion worth of apartments acquired in their history, and hundreds of thousands of units either acquired or developed over their history. So it's a long-standing player in the residential real estate space for institutional investors. Your program, we would like to see your program boost its residential exposure. It matches what we recommend as, kind of a growth strategy to focus on, and we think you need probably another $600 million worth of residential investment in your portfolio. So this is a good step towards that. You're growing. We're under-allocated to real estate, and we want to improve exposure to sectors that have better fundamentals, and all residential strategies fit that category. So this is a good portfolio fit for your portfolio. And I think with that, I'll leave it at that, unless
Thank you. Hi, I'm Richard Boynton, CEO of Fairfield, and, first of all, just want to say how excited we are to be here today and really appreciate the opportunity to present to you guys. We think that it's a great time to invest in multifamily, so we're hopeful that we can begin a relationship with you where we can help you guys to meet your investment goals. I know I don't have a lot of time, so just want to give you a quick overview of Fairfield and wanted to cover some of the information that is on, I believe, slide 159 in your deck. So first of all, we've been in business for nearly 40 years, been one of the most active investors in the multifamily real estate space during that time, with nearly 300,000 units either acquired or developed. As Rob mentioned, we're vertically integrated, meaning we manage our own properties and we act as our own general contractor. We think that gives us a lot of information about our properties that makes us a better investor. Also, our executive team has significant experience both within the multifamily industry and at Fairfield. We have an average of 25 years in the industry and 15 years at Fairfield. We only invest in multifamily, so that's our area of expertise. We invest nationally and have vehicles that invest in all of the various strategies within the multifamily sector, all the way from affordable housing to value add to core plus, as well as ground up development. Then lastly, as was mentioned, since 2019, we've been majority owned by the California State Teachers Retirement System, who is also investing in the proposed fund here as a limited partner alongside the other investors in the fund. And with that, I'll turn it over to Margo Ragland for a overview of the offering today.
Thank you, Richard. I'm Margo Ragland. I'm Vice President of Capital Markets at Fairfield, and I'm going to share some details about the Value Add Fund 4 offering. This is the fourth fund in Fairfield's Value Add Fund series. Over the last decade plus, we've invested over $2 billion in equity in the prior funds. We've navigated varying market conditions, and we've delivered significant outperformance in each of those prior funds in the prior vintages in the fund series. For Value Add Fund 4, we're targeting a $1 billion fundraise with a hard cap at $1.2 billion. We've so far closed on $800 million of equity commitments into this fund vehicle. We are currently planning for the final closing of the fund in January 2025, and we expect the total fundraise to land somewhere between $1.1 billion and that $1.2 billion hard cap. The return targets for this vehicle are a 13 to 14% net IRR and a 1.7x net multiple. Those return targets are in line with the return targets of prior vintages in the fund series. Our strategy for Fund 4 is focused on acquisitions of properties, of multifamily properties in our target markets in 2024 and 2025. Prior to this year, we did not make any fund investments, but this year we've already made 14 investments for the fund and committed $337 million of equity. So it's been a pretty busy year for us in terms of investments in the fund. And with that, I will pass it on to Wes, who's going to review the market opportunity that's underpinning this investment strategy.
Hi there, Wes Dickerson. I oversee acquisition efforts here at Fairfield. This is a unique opportunity for the fund to take advantage of the current and temporary dislocation in the multifamily operating fundamentals, as well as multifamily capital markets. This dislocation has led to a 20% decline in multifamily values from the peak in 2022. And the operational dislocation has really occurred in the amount of supply that's being delivered to the market. That's leading to flat to declining net operating income. Now, that supply is temporary. There's very limited new supply that's expected in the multifamily space over the next 2 years, 25, 26, looking forward. So a temporary decline in NOI. In addition, the capital markets dislocation is really occurring as a result of a record amount of loan maturities that are occurring over this year and next year. The loan maturities are occurring as a result of new construction loans coming due, but also a real uptick in terms of short-term financing that was used to finance acquisitions in the 1 and 20 vintage, and that's leading to stress and distress on those owners that elected to acquire during that time period. So, as a result of flat to negative NOI, increased capital markets costs, leading to forced selling, which is an opportunity for the fund to acquire at what we believe to be really attractive values on a long-term duration and value creation opportunity. With that, conclude our presentation.
Thank you. We'll start. Member O'Donnell, do you have any questions for this manager?
I do not. Thank you, though.
Morning. A couple questions for you. What is Class B, C properties?
Yeah, I'll take that. So generally, we classify properties by age, and so when we're looking at properties, Class A would be newer vintage properties, you know, that we would look at around 10 years or less years old. Class B would generally range between 10 and 20, 25 years old. Class C generally older than that. You can have properties that were built that maybe were built and would be Class C, except they've been fully renovated, and so maybe somebody took a Class C property, renovated to make it a Class B property, but when you're looking at properties that are unrenovated, that's kind of how we look at them.
Madam Chair, when you're looking at all of your properties, what's the cost of rent once they're developed, more or less?
It varies quite a bit depending on market, and so Fairfield generally doesn't build the, you know, top high-quality urban projects that have the highest rents. We're usually looking for, you know, our thesis for building is generally to build properties that are at a lower basis and more attainable to renters. And so we typically have lower density, more suburban products. So on average, our rents can range from $1,500 in a market like Texas to, you know, in the $2,000 to $3,000 range in a market that's more expensive, like a California market. That's for our new development.
Madam Chair, can you give me a perspective of what those look like, or do we have a picture of them, some of the ones you've done in the past?
I don't know if we have a picture in the presentation here.
Like, is there anything specific to senior living or family housing, or is it just multifamily business?
Yeah, so it's, what we build, is generally just traditional multifamily. On the acquisition side, we also acquire, we own senior housing properties and affordable housing fund, you know, and, have a much wider range of what we buy. But typically what we build is, you know, anywhere from garden-style properties, which are generally 2 to 3 story projects, all the way up to mid-rise, which can be, you know, 70 stories.
And on these acquisitions that you're acquiring, what does that process look like?
So we have an investment team that's spread throughout the country that's looking for opportunities, that networks with other owners, looking for opportunities when somebody wants to sell, also works with brokers in the market. So we identify properties that we think are undervalued, or have the ability to be able to spend money to renovate the properties and be able to create value with the property through that. And we have our in-house underwriting team in San Diego that underwrites each asset, and then, you know, if the project meets our investment criteria, then we'll move forward to submit an offer and work through the process to acquire the property.
What happens to the residents typically of a property you acquire?
So the renovations we do are always on turnover, and so we're not forcing out any tenants. You know, we, as a tenant moves out, we'll renovate the unit for the next tenant, and the rent will generally be higher because of the renovations we do. But, you know, as mentioned before, we're owned by California state teachers, who have similar concerns about what happens to residents, and so we're very careful, you know, on what we do in this regard.
Do you have like percentages around like what percent of residents move out in the first year of acquisition or something like that?
Yeah, so in our market rate portfolio, our typical turnover is been around 50 to 60%. That's an industry standard, and so that's not just unique to Fairfield. You know, people living in apartments, it's generally kind of a shorter term, so you get a lot of turnover.
So what you're saying when you say that's an industry, metric, or
It's typical
in
of
line
what
with industry, that means that residents have that turnover whether the property has been acquired or not, is that what you mean? Oh, wow.
in our affordable housing portfolio, you know, we have, our turnover is generally about half of what it is in our market portfolio.
Another perspective that I would offer is a lot of times if the current owners are experiencing financial distress, the capital spending and maintenance spending goes down, right? And so when somebody like a Fairfield comes in, part of the value proposition is deploying the capital to raise the standard of the housing stock, and so there's a net benefit in that as well.
Well, Madam Chair, it depends on what side of that you're on. If you're barely affording where you're at that moment, values go up, the rest of the people end up either leaving or having to be placed elsewhere.
No, I understand that perspective as well. There is the risk that you know, properties that aren't adequately maintained create poor living experiences for the people who are already there, and so there's a delicate balance.
And that's exactly why I wanted to ask the question is, where's your balance in all of this?
So we do our renovations over a longer period of time. We're not moving tenants out, and because we're doing it over a longer period of time, we're trying to achieve higher levels of cash flow during our hold. So we want the tenants that are there to stay, but as tenants move out, then we'll renovate and increase rents, you know, for the next tenant.
And we also address deferred maintenance at the upfront acquisition. So if there's deferred maintenance, we also renovate that component. That's not an income-producing thing. That's just fixing up the deferred maintenance at the project.
Which is particularly important in this environment with distressed capital structures. Owners are using all available cash to service their debt as opposed to taking care of some things that need to be taken care of at the asset level, which improves the overall community experience, but also creates liquidity at exit for an institution. Very basic things that should have been taken care of, just being neglected due to the capital-starved nature of the asset, which is what you're referring to on the deferred maintenance side of things.
I noticed a lot of the areas that you are in, of all of the funds you've had, have you done any work in New Mexico? Built anything in New Mexico?
We haven't.
Is there any idea of moving into New Mexico or deciding to do that, especially if it's $350 million?
We are, in fact, Wes is looking at some properties later today here in New Mexico.
And then has any of the, let's see, so you mentioned the net IRR, but in the past three funds, what did we confirm was the net IRR, or has that been able to be calculated?
So Fund 1 was realized with a 19% net IRR. Fund 2 is also realized with a 24% net IRR. Fund 3 is 60% sold, and the projected net IRR for Fund 3 is at 16%. What we've sold already in Fund 3 has actually returned a much higher performance, but again, we're projecting for the full life of the fund, conservative projection.
And then, Madam Chair, I think this one's for Townsend. What are some of the risk factors?
Yeah, well, I think the risk factors that we focused on and we due diligence primarily relate to the ownership and trying to make sure that there's a good alignment of interest with the management team. This is a platform that's been in existence for close to 40 years, and what you have is a combination of, there's been some turnover, but there's also been succession based on retirement, and you've got a lot of folks that have been with Fairfield for a long time, and if you look at the tenures, and our materials, we have a detailed report starting at page, I think it's 133 in your materials. But if you look at the tenure of the people at Fairfield, it's generally pretty long, and the senior leadership is retiring out and being replaced. And that creates, kind of a series of succession moves within the organization or bringing in new people, such as Wes. So we spent quite a bit of time on platform stability, got comfortable with that, and then we moved to alignment of interest. And we think there are some factors that are good about this platform. For example, the fund will earn incentive fees if they hit their performance targets and exceed their performance targets. And 45% of the fund's promoted interest will be shared with the management team. And beyond that, I think to about up to 40 people across the organization. So pretty widespread sharing of profit. And then there are some initiatives underway to create better equity-like ownership amongst the leadership team at Fairfield. And we think that they're making a good faith effort right now. Nothing's in stone yet, but they're making a good faith effort right now to put some kind of equity ownership in place for the leadership at Fairfield. So we think they're moving in the right direction in that perspective as well.
Madam Chair, what are the target markets for this fund? With the first group with California, Las Vegas, with that group?
Yes, it's on the map, the markets that are shaded in blue.
On slide 160 in your material?
Yeah.
Yeah. So there's one little box there that doesn't have blue in the same area. I struggle, just out of all honesty, they all know this, so I don't know, somebody probably forewarned you. But I struggle with giving money for investments and it not being invested also in New Mexico, especially when your target group is in that area. So that concerns me. The second thing that concerns me is this is a new relationship and we're planning on $300 million. That's a lot of money, even if we do have $58 billion. That's still a lot of money on a first-time relationship. So I want to understand that perspective. And then I want to go into, before that, I'm curious about your page 162, your values, the DEIB mission and vision. If you could just give me some guidance on that, because I thought that was a pretty interesting slide.
You want to start with that, or I can? Sure. So I can speak to that just as a member of the DEIB committee. So I'm actually a founding member of the DEIB committee, which was formed in 2022. And that was following an initiative where we hired a specialist consultant to come and work with Fairfield to help us both analyze sort of existing metrics and, potential gaps in terms of our diversity, equity, and inclusion sort of efforts, and also identify opportunities for us to improve. So since we've sort of formed that committee, and we have a lot of support at the executive level, and I think, you can speak to that as well, Richard. Generally speaking, Fairfield has a high level of ethnic diversity across the company. We also have, a fair level of gender diversity. I think overall the company has 45% women and 55% men. So where we do see opportunities to enhance sort of the equity in terms of opportunity at Fairfield is the levels of executive leadership and among our investment professionals to kind of have better equity and metrics at those higher levels in terms of the company. So that's a focus of ours. Something that's kind of specific to Fairfield in terms of how our company is structured is we have, on-site at different properties. We have a lot of employees that are on-site, and then we have our corporate employees. So one of our initiatives is also to try to improve the inclusion that the sort of different on-site employees feel as part of Fairfield. That's one of our initiatives that we've taken on. The committee is also focused on the transparency of this information and really galvanizing the support of DEIB ambassadors is what we're referring to them as. It's people outside of the committee that have demonstrated a real interest and engagement in the DEIB initiatives at Fairfield, and they're serving as ambassadors to collaborate, share ideas, and help execute those DEIB initiatives with sort of broader support throughout the organization. That's a couple of points.
So based on that, and that page, in what you just said, on your target markets for the people who are housing into your Fairfield apartment complexes, what's the percentage breakdown of that? You know, versus income versus race or ethnicity or anything to do with your DEIB?
Yeah, I think, we don't have specific metrics in terms of the ethnic diversity of our resident base. We do, for our affordable properties, so a significant portion of Fairfield's platform is invested in low-income housing tax credit properties. These are regulated affordable housing properties. It's been something that Fairfield's invested in for decades. And in that bucket of investments, we do have sometimes more information about the residents because we do have to register or certify the residents' criteria for their income and their employment. So for that segment of our resident base, we do have more data, but we don't have that sort of platform-wide, and I'm personally not sure what we're allowed to disclose in terms of.
Yeah, we comply with all fair housing laws,
Information on that
and
data.
so, it's, I think, tracking data for across our market rate portfolio regarding race would be something that might run afoul of fair housing laws, so.
I was just curious overall. So you mentioned 45% women, 45% men, Madam Chair. Well, you said 45.
55% men,
55.
45.
What's the breakdown of minority workers in your top leadership?
Yeah, so in the top leadership, so there's different ways to look at that. So for the so the segment that we would call investment professionals, there's different ways to, I guess, if I was to group the term minority into non-white, is that helpful?
How about brown and black, or Indian?
Well, we have those all separated, I just don't have the detail for you at this moment,
Well, I
so.
can give you at the top. So one of our 3 board members is minority. One of our 5 executive committee members is minority. We're working on trying to get better racial diversity within our investment teams. I'd say as a company overall, we're majority minority, when you include all of our, people that work at properties. And so, it's the investment team that's been our big focus to try to improve our diversity. We've instituted internship programs to bring in, people of color to, be able to advance within Fairfield. And so, we're hoping that some of our efforts will pay off with better racial diversity within our investment.
The reason why I asked all of this, Madam Chair, is because I really was interested in the slide that you guys mentioned, and a lot of times we have that, but then putting action to words is a little bit more challenging. And then right after I saw this page, and I didn't see anybody that is minority that is like New Mexico. So I guess from my perspective, I also look at the reflection of our state. We're a majority minority state. We're not included in any of where you're going to be using a lot of the funds, but yet everyone around us is, but yet we're investing quite a bit of money into. And I'm on the housing board, so this does matter to me a lot. We have a crisis in New Mexico. We have a shortage of houses in all different realms from all different levels that we've been working on. The legislature has given us some money to assist with that with New Mexico Housing, which is New Mexico Mortgage Finance Authority, and they also have affordable housing that you could I could connect you guys. But these are just some of the things that I think are really important, because when you guys are in your leadership meetings, you do have a lot of diversity. It's the laborers, but you don't have a lot of that diversity up at the top. And so there's a disconnect. And for New Mexico to have the second largest permanent fund, and we have a majority minority, we keep continuously investing in everything that doesn't look like New Mexico per se, or doesn't come into New Mexico. So I'm just putting that into perspective. Thank you. Other questions? Actually, I do have a question. How opposed would you be to the idea of, if this were to go through, that you include New Mexico
As a target market?
as a target market?
Yeah, so the markets that we have shown here in blue are historical target markets, but with a fund of this size, obviously, we're gonna be looking for opportunities where we can find them. As I mentioned, Wes is looking at properties today. They're in New Mexico here, and so I think we would absolutely be open to putting it as a target market.
Great, thank you. And I'll be happy to connect you with, the Director of Housing.
I just ask, could you talk about what are some of the things that go into selecting target markets? I mean, as in population growth, economic growth.
A lot of it is, it's growth and then also institutional, activity. And so because this is a, fund that is relatively shorter term, we're very focused on our exit and who we're gonna be selling to. And so, you know, looking for markets where other institutions are active and there's a robust market to be able to sell to. So, you know, I'd say the normal demographics targets and incomes growth and that, but then also institutional.
I have to say, I have a lot of the same reluctance that the treasurer expressed. I thought that it was positive to hear you say that the turnover rate in your affordable properties is half of what it is in your other properties. That sounds great, that folks who, you know, have a harder time attaining housing, hopefully have a little bit more stability. That's sure. And it is pretty ballsy to come to the New Mexico Investment Council and identify all of the target markets completely surrounding New Mexico and not including New Mexico. I mean,
Well, I think, as we said, we are open to that.
I'm glad to hear that
It just hasn't been a
you're
focus of the
pursuing
marketing
that
story.
and actually have something on the books.
Yeah.
Is there a motion?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Townsend, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $200 million to Fairfield U.S. Multifamily Value Add Fund 4, and an additional commitment of up to $100 million for a related co-investment vehicle, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
And I would amend that to include contingent upon New Mexico being included in that fund. You okay with that?
Well, I mean, Madam Chair and Treasurer, I don't think we can mandate to a manager of investments market our own. I mean, I think we ask them to commit to evaluate, or saying that they would have to commit to make an investment.
They just agree to it.
I think, yeah, we could certainly agree as a target to include it as a target market. I don't know, you know, it would be hard to commit to being able to actually invest because we don't know what properties would be available, what prices they would be at, what kind of return.
Amend the motion, New Mexico as a target market. We have a second. Second. Okay, we have a proper motion by, Chair Bingaman, a second by Madam Treasurer. Discussion on the motion before the council. Hearing none, if we could take a roll call vote on this motion, please.
Commissioner Stephanie Garcia Richard,
Yes.
Treasurer Laura Montoya,
Yes.
Nick Teas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer.
Yes.
State in the affirmative, motion passes.
Thank you all.
Thank you.
Appreciate it.
Thank you so much.
Thank you. Thank you for answering our questions.
We appreciate it.
All right, with that, we're gonna turn it over to Director Cassidy for, I think, the next 4 items. So.
Thank you.
Thank
Get
you,
comfortable.
everybody.
Thank you so much.
Good morning, everyone. The materials for this start on page 175. We have 3 investments this month, 1 for our national program, 2 in our New Mexico program. All three are existing managers, but they're new fund series being contemplated. And additionally, at the end, we have a clarification on investment last month where the motion wasn't quite correct. We're starting with TCG Labs, which is a fund being raised by the Column Group, which is an existing manager in the program that we committed to last year. We're joined by Richard Pugmire and Peter Sten-Nielsen from the Column Group, who's a managing partner and founder of the firm, is joining us on Zoom. We're in annual general meeting season, so it's hard to get everybody here for every month, but he's joining us via Zoom. We're recommending a commitment of up to $50 million, what they're calling TCG Labs Opportunity Fund 1. And as you recall, last year we invested in TCG Labs Fund 1, which is the early stage version of this fund. As a reminder, TCG Labs invests in single antibody assets that are generated from a single laboratory called Celio Labs that is exclusive to the Column Group and incubates and manages drug discovery projects like a contract research organization. Relative to the original expectations, and then Peter will talk about this, TCG Labs and Celio Labs have proved to be much more productive than originally expected in terms of identifying potential drug targets. And based on this early success, they're raising an opportunity fund that's a similar size to the early stage fund to finance the assets through the relevant clinical trials of the assets that have been identified. This is kind of a unique opportunity, and if it does work, I believe it can produce significantly above average returns given kind of how disruptive this model is in terms of capital efficiency and how high the ownership they can have in each individual asset. I'll pass them on to Richard to talk about the fund in more detail.
Thanks, Chris. Madam Chair. So just to remind you, we made a commitment last year to TCG Labs 1 for $50 million. This fund is related to that in that it's doing later stage investments in those companies. What we like is the TCG Labs team is very experienced in this space, particularly antibody therapies, which is a growing area of biotech. And this approach is a very innovative one where they're working with one lab that's operated by one of the team members to develop the drugs rather than building a company around each of the molecules that they're developing. It's a very efficient way to do it. When pharmaceutical companies want to acquire, they want to acquire the molecule, the science. And so as the drugs go through clinical testing, I mean, these companies may be acquired, which drives the return. This fund in particular is expected to invest Series B or later. Typically, the fund is expected to benefit from the same team and resources as TCG Labs. We like that the fund has a senior experienced team. They also have the support of several scientific partners in the community. And the strategy is to further support those select assets from TCG Labs that may need more development before being sold to a pharmaceutical company. The Column Group itself has a strong track record in their flagship funds with multiple investments generating over a 10 times performance, which is what we like to see in the early stage venture space. They have success in incubating drug development companies, which is a similar strategy as TCG Labs. So we're recommending a commitment of up to $50 million to TCG Labs Ops 1, and I'll turn the time over to TCG Labs team.
Hello, this is Peter Samuelsson. I have my annual meeting to all my investors, about 150 of them traveling in from all over the world, tomorrow. Otherwise, I like to stand in the room where I present so I can look people in the eye and walk around the room as I present. I'm the founder and managing partner of the Column Group, and I started the fund in 2007. I built the firm together with the first scientist that went directly from his PhD to Genentech. He was the first scientist at Genentech. Before that, he was a rock climber and lived in Yosemite National Park and trained himself on eating as little and drinking as little as possible, so he wouldn't have to bring a lot of stuff with him when he climbed the rock faces. He was one of the first people in the world to climb El Capitan, which if you go there, it's an impossible feat. So that's just the kind of partner that I want to have. At Genentech, he's the inventor of human growth hormone, as a drug, insulin, interferon alpha, interferon gamma, which are two cancer medicines, TPA, which dissolves blood clots in heart attacks and strokes. His medicines has saved hundreds of millions of people's lives. So he is perhaps the most highly regarded drug discoverer in the world, and I'm lucky that he has been my partner at the Column Group for 18 years. I wouldn't have necessarily, even though my whole family are nurses and doctors and medical scientists, I was the black sheep and I studied mathematics and economics, but I was drawn back by my upbringing to medicine, even if that's not my original area of expertise. So I started the Column Group in 2007, and we now have 10 funds with $4 billion in commitments. I believe my investors tell me that we are the number one performing biotech venture group. Our exit multiples when we sell companies, we've sold 8 companies to pharmaceutical companies, and we've got returns like the worst ones are 3x, 3x, then 8x, 9x, 9x, 12x, 24x, I forgot 21x. So we get very high returns. 70% of all of our companies become worth more than $1 billion. And that means that they're finding a drug that solves a major medical problem and is on its way to market. That success rate is surprising even to us. And I think it is because we don't value business opportunities. We value the quality of the science, and we value the quality of the scientist that works with us. And as such, and we go slowly. We only start about 3 companies per year in our main funds, and we spend all of our year just building those companies. We're not worried what other investors in our field are doing, because investment themes come and go, etc. We just build companies that should be the same quality as Genentech was in its early days when it was founded. So our 10 funds are the most mature one that is sort of indicates what happens when a fund goes towards its termination. It's heading for a 6x return. And that will be an IRR of roughly 30%. And the other funds are tracking sort of after that, but they are younger and younger funds. So the next one is at 3x, the next one is at 2x, but they are started sort of 7 and 9 years later, respectively. I've been very lucky in getting investor support for our funds. And my main mentor is our largest investor, and unfortunately, he passed away this summer. That was Jim Simons, the mathematics professor, the founder of Renaissance Technologies. And he asked me the most difficult questions. He was a professor of mathematics that turned his mind to the financial markets, and what was over the last 30 years the number one performing investor in the world. I sit on the board of the Institute for Advanced Study in Princeton, and he was on the board with me. I never wanted to beat my chest or talk to him about because we were there in an academic institution, and I didn't think it was appropriate. But one day he got frustrated and said, "Peter, what is it that you do?" And then I told him. And then we became very close. I used to travel to New York to see him every quarter to report, in particular, the numbers of our performance. And so he became our by far largest investors. And when that spread and people looked at our returns, we got Michael Bloomberg and Sergey Brin and Larry Page and Jeff Bezos and Steve Schwartzman of the Blackstone Group, David Rubenstein of the Carlyle Group, Henry Kravis of KKR, Howard Schultz of Starbucks, Phil Knight of Nike, the Wertheimer family that own Chanel. We also got Harvard University, Columbia, Rockefeller, University of California. We got Nobel Prize Foundation. We got U.S. National Academy of Science, a bunch of sovereign wealth funds around the world, including Japan Post Office. And we've had an amazing backing of our funds as we grew more successful. When I sold our companies to pharma, these are our children. I don't have my own children, so my companies are my children. My dogs and my companies are my children. And when I sold them proudly and handed over the keys to the house, sort of. And then, of course, you stay in touch with your scientist friends. And over time, I heard that the whole scientist group, the best in the world at breast cancer, or the best in the world at prostate cancer, the best in the world at kidney cancer, the best in the world at epilepsy, they would just let go. And of course, I could hire them again and do something else good, but it just felt so useless having built that company for 5 to 15 years. And then just to see that the pharma, all they wanted was the lead product. So it made me really frustrated. And I told you I was lucky to have Dave Goodell as my partner. When he one day steps aside, my replacement for Dave is Jin-Long Chan. He runs TCG Labs. He used to work in a biotech company, and we had lunches every month to discuss the day we would work together. Well, now we work together. He heads TCG Labs. And the structure of this was my frustration that the labs gets fired after a year. And I want to build companies like Genentech, or Apple or Microsoft, or that is able to become the best in the world, not over 5 or 10 years, but over 100 years. So that was the idea of creating a laboratory that pharma couldn't touch and destroy. But that's an evergreen laboratory where the best scientists in the world should want to work. And instead, when they
Let me go back and stop you right there.
Yes.
And see if anyone, do you have anything else? Okay, let me see if the council has any questions. I'll start online. Are there any questions from council members? What's the pleasure of the council?
Here I have a motion, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $50 million to TCG Labs Opportunity 1 LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and appropriate paperwork.
Do we have a second?
Second.
Second by Councilmember Summers. Any other discussion? Will you please call the roll?
Thank you.
Commissioner Stephanie Garcia Richard. Treasurer Laura Montoya.
Yes.
Nick Tayeb.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
I may have a conflict of interest, so I will abstain from voting.
Thank you. Kurt Summer.
Yes. Yes.
6 in the affirmative. Motion passes.
Thank you.
Thank you.
Thank you very much. We
Thank you.
appreciate you online. Good luck with your group of people coming in. Let's move on to 3E. Mr. Cassidy.
So now to the New Mexico program, joined by Brian Somerville and Cash Allred at Antler. As a reminder, the SIC committed $40 million to Antler US Fund 2, which is Antler's US pre-seed venture capital fund. And Antler, similar to a lot of accelerators, runs in a cohort system where founders are selected to participate in a couple cohorts a year. They go through a program, and if successful, they receive initial inception / pre-seed funding.
already been a couple founders in New Mexico that have received funding from them, one who already lived here and one who actually had spent part of his childhood here and decided to move to New Mexico after he received funding. The new fund we're talking about here is a 15 commitment to what's called Antler US New Mexico. This will be an SMA that will invest largely at the seed stage in companies that either go through the Antler program, the pre-seed program, and move back to New Mexico, or other types of startups that may be interested in moving here that may not have gone through the Antler program. And at a high level, one thing that we're realizing as we fund a lot of venture capital in the ecosystem is I think founders are excited to work with groups like Antler, but once they move back home here, there's a benefit to having some density and a presence on the ground where they can be together with other high-achieving founders. And this is what this is trying to help achieve. Antler will create a physical office out of which all their portfolio companies can operate. And we're hoping that that level of talent density in the ecosystem makes it a little easier for founders to build here. I'll pass it along to Richard to talk about the fund in more detail.
Thanks, Chris. We're recommending a commitment of $15 million to Antler US New Mexico LP. And like Chris said, this is like a separate account focused on the New Mexico-based companies alongside the program's commitment to Antler US Fund 2, which was done last year. And Antler does focus on seed investments globally. The US Fund 2 is their focus on pre-seed and seed investments in the US. One of their differentiators is they run this 6 to 8 week program with entrepreneurs where they work with them on things like team formation, product development, market validation. It gives them a chance to evaluate the entrepreneurs as well and decide who they want to support and invest in. And post-investment, they've actually developed a lot of value-add resources as well to help companies. So this fund is specifically focused on seed investments in New Mexico-based companies, either companies that are already in New Mexico or with founders willing to move their companies and be headquartered in New Mexico. And Antler already has a full-time professional in the state, which is Cash, and they've invested in one startup that was located here, and then also one startup where the founder moved to New Mexico. So as Chris mentioned too, they are going to open that physical space as well, which we view attractive because, I mean, there's going to be more knowledge share there, and Antler can actually utilize their resources to help those portfolio companies develop. The team overseeing the fund is the same team as the U.S. Fund. Fund terms are largely the same as U.S. Fund 2, and from a track record perspective, U.S. Fund 1 is still pretty early with an average hold period of 2.6 years. Just one differentiator with this compared to U.S. Fund 2, it's going to be more concentrated, with a target of approximately 17 companies. And so the performance of the fund is going to be driven by more so by the performance of each of those companies as opposed to U.S. Fund 2, which is a lot more diversified across hundreds of companies. So we're recommending a $15 million commitment to the fund, and I'll turn it over to the Antler team.
Thank you. Good morning, Brian Somerville, General Partner with Antler US, joined by Cash, as Richard mentioned. Cash is our Antler investment lead for the state of New Mexico, based here. I want to start by thanking all of you for your continued support. I think we've made a tremendous amount of progress in a relatively short space of time, both with respect to U.S. Fund 2 and that performance. Some leading indicators there are quite positive, as well as our specific efforts here in the state. I also want to give a particular thank you to Chris Cassidy. Chris has been a really invaluable resource for us, both on a firm level on the ground here in New Mexico, as well as the founders we work with closely together. So we're very excited to deepen our partnership and continue to work together going forward. I think that over time we can have a tremendous and sustainable impact on the state. This is the next iteration of that, where we feel like we can fill a gap at the pre-seed level, which is the commitment that you previously made last year, and then fill this kind of seed to seed plus gap in the market, which I think is fairly considerable. And then over time, I believe that we can work together to bring a larger capital stack to the state and continue to support companies as they mature further and further downstream. I think that with our infrastructure and with the continued partnership, with the state, we can have a fairly long-term impact. Our belief is that it really only takes a small number of companies to have an enormous impact on a state like New Mexico. We have acknowledged in the proposal the kind of dandelion effect that we referenced, where one breakout success then spurs the next series of successful companies in an ecosystem like New Mexico, where the next set of founders, the next set of employees can spin out and build new companies. us having a larger presence, particularly a physical presence on the ground here in the state, we believe will lead to a more sustainable impact over time. So again, thank you for all your support thus far. Really excited to be here and continue to deepen our partnership. I'll pass it over to Cash. Cash, again, came on board immediately after us receiving investments from the state previously, and has done a brilliant job on the ground here, both working with founders in the ecosystem as well as deepening our connection to local venture folks and investors here.
Thank you. It's probably helpful to share a little bit of my story of moving to New Mexico and how that happened. So I've been investing in non-coastal VC markets for most of my career, and relocated from Colorado to New Mexico at the beginning of this year. And have been meeting with truly every entrepreneur that has approached Antler about building a company, seeking mentorship, capital, and learned a lot. The investments we have made, not only were they good entrepreneurs, one that was already here, one that relocated here, but through our work with them have raised even capital after our investment from investors outside of the state through introductions and resources that we provided for them. So we know that we can do it here, which was something that we were excited to prove. And the other element of New Mexico that we're quite excited about is leveraging the broader Antler platform to bring these companies truly from day zero, maybe it's idea, technology, all the way through the full capital supply chain. And the entrepreneurs themselves have been asking for, to quote, maybe keep the party going after these 6 to 8 weeks of working together with them in our offices outside of the state of New Mexico to do that here on the ground in New Mexico. With that, we feel that not only will this additional capital fill the capital needs of these companies, but we'll be able to attract companies even if they do not go through our pre-seed programs, but to jumpstart the number of companies that we have at any given time within the state is going to be quite critical for both the experiences of the founders and the likelihood of success of hitting these big winners that will have a big impact on the state.
Thank you. I had a question on one of the considerations. It could be a positive or a negative, but I just wanted to get your perspective on it. That you're planning on investing in at least 17 new base companies in New Mexico. I think that's great, but I know it's a lot more risk. There's a lot more factors that need to be considered. So what is sort of that process for you guys? I mean, it sounds like you've been getting a lot of success on this.
I think from a deal sourcing perspective, this opportunity opens up the aperture considerably. So the way we think about the buckets of founders that will be eligible for this is multifold. So first and foremost, it'll be local founders on the ground here in New Mexico, and Cash has done a brilliant job there. But not only at a pre-seed level, but at a slightly more mature level. So companies that may have already found some semblance of product market fit, maybe have raised a little bit of capital in addition. There is from our perspective, larger sample of founders that kind of fit that requirement. The second aspect speaks to our infrastructure around the U.S. So we have programs that we run in New York, in Austin, Texas, and then planning for California. The intention is that as companies mature out of those programs and we complete our due diligence, we will advertise New Mexico as an opportunity for folks to come here and build. And we had an experience earlier this year doing that, where we held our portfolio offsite in Santa Fe, brought all of our companies here and tried to attempt to kind of advertise. And that's one of the reasons why one of the companies has already ended up relocating. And then the third, I suppose, concentric circle is the global nature of what Antler has around the world. So we have 1,400 portfolio companies we've invested into since 2018. We're technically the most active volume venture investor in the world. Inevitably, those companies overseas will be attracted to come to the U.S. from a fundraising perspective, certainly from a talent and hiring perspective, as well as just kind of market access for the U.S. more generally. If you're building a smaller market, perhaps Southeast Asia, this is very attractive as you mature as a company. So, we're attempting to create more of a landing pad for those global companies to consider a place like New Mexico as opposed to the, I suppose, natural inclination, which is to go to a place like San Francisco or New York. We feel like advertising New Mexico to that audience, as it grows quite considerably, will attract more folks to the state. And that's more relevant for this proposal in the sense that we can contribute continuity capital to them as opposed to the initial capital, which they would have already received from our programs globally.
Let's talk about the funnel, the acceptance rate.
Yeah.
The folks that receive investments, including the two already on the ground in New Mexico. They've gone through
It's fairly rigorous and continually more and more selective. So, from a U.S. perspective, we accept roughly 3% of total applicants into these residencies that we've done. But what's unique about our model is that we're not investing at the outset. We invest, post 8 weeks. So we view our advantage from a diligence perspective as working with these companies in person to make what we believe to be a more informed decision at the end. So we invest at the end in a median of 10% of the companies who acceptance into the program. So each one of the companies from the Mexico platform so far have gone through that process. As our funnel grows, and it has grown quite a lot, we will continue to be more and more selective over time, and just hold a higher bar for founders that are coming in. Now we've had about 6 years of data to kind of look at the historics for the firm, and there's a very clear correlation between how selective we can be relative to what the underlying cohort performance is. Because the leading indicator, I think, is important. We are on a trajectory this year to have about 20,000 applications for the U.S. Program alone. Last year, 2023, was about 8,500 folks, and the year before that was about 4,500.
So 20,000 this year?
20,000.
8,500 last year?
We are on a run rate to have 20,000 this year. It's grown quite considerably. And I think there's multiple factors to that for what it's worth. There's, I think, the Antler brand value growing across the U.S. I mean, in 2019, we landed here and we weren't well known. Now we have a bit of a track record. We also touch so many founders that you have a bit of a network effect there where founders tend to know one another and they can say, hey, I went to the Antler program, had a great experience. This could be a good fit for you. And we do a lot to kind of energize that alumni base in perpetuity and maintain continuity with the community. I think the other aspect is the reception that we're getting from downstream investors. So we tend to be complementary to everyone else in the ecosystem because we're really creating our own deal flow from scratch. We're not competing with folks at a later stage. So more and more referrals have come from those downstream funds where they may come across a founder that is very compelling as an individual or a CEO, but the company metrics may not quite be there yet. Antler can be a great landing pad for those founders, and then we pass them back along downstream. So you create this kind of symbiotic relationship in that respect. And those are probably the main drivers. I mean, there's also social media and folks kind of finding out about us organically, but the growth has been really encouraging for us.
So, yeah, in terms of just, in terms of the risk, it's a smaller cohort of companies, 17, that's obviously a small sample size, but it's a highly selected group of 17, so I think it mitigates some of the risk of a smaller number.
Madam Chair, this is for you, Mr. Cassidy. I'm glad that you're utilizing him and his skill and his resources. He has a lot of them. There's a comment in here about Antler versus Roadrunner Ventures, and I remember when we used that, it was sort of like, for lack of a better terminology, sort of like a bridge scholarship to college from high school. It sounds like very similar. So how are they the same or how are they different? Or do they do sort of complementary stuff for different venture capital? You can go to these two bridge scholarships and they help guide you into, your great ideas.
Yeah, so there's, as we think about kind of developing this program, we're looking for a bunch of different ways for founders to have opportunity to raise money on their terms. And so you look at Roadrunner, which is quite unique. You saw Dr. Luis Chavez in the lab, who's a research scientist. Like, where do you start? So, like, going into a Roadrunner where they help you basically build from scratch, iterate on the product development, find corporate executives. That's a very unique model. Not for everybody. You have an accelerator like Antler where in exchange for giving up a smaller percentage of your equity than Roadrunner does, you're asking for their help. And frankly, part of the help is it's validation of you as a founder, it's a validation of the idea, and it's also, I think long-term the hope is good accelerators will result in actually less dilution over time in terms of raising money. Hopefully, it's easier to raise. You're around a good network of other founders. And then there's people who want to do it themselves, and that's where groups like Outlander come in, where some of those founders just want to go straight to running their business. Maybe they don't want to go through an accelerator, maybe they don't want a studio, they just want to start on their own. So when I look at us kind of developing a diverse enough program that it can meet founders wherever they are, that's, I think, what we're trying to achieve, is that particularly at the inception stage where get these folks on the fairway with the best partners they can find early on, because I think that'll increase the success longer term. And every founder is going to have a different view about who that right partner is. And so that's
think as we do more investments in the program, you'll see some diversity at this stage because everybody's gonna have a different view. I don't know if you guys wanna add anything.
Well, perhaps, Cash, you can touch on your relationship with Roadrunner and the work you've done.
Yeah, both Roadrunner and Outlander that you also mentioned have become friends. I've gotten to know Adam quite well over the last year. And I think that most entrepreneurs, when they're moving to, say, like New Mexico or they're building in New Mexico, they truly care about the founder density and also the access to the expertise in the room. And in collaborating with these other groups, we plan to invest in some of the same companies, not all of them, but we want to support across our portfolios because at the end of the day, successes across the New Mexico ecosystem benefit all of us in terms of talent and capital and perspective. Our own companies go out to raise capital, and so we've already found success in doing it.
We've got a question online from Member Allen.
Yes, thank you, Madam Chairman. A question about, do you have a formal program of mentoring the founders that you take on, that you invest in? How do you do to help those founders, whichever way they come to you, understand, various Series A, B funding, kind of the whole process? What do you do to mentor them?
Yeah, absolutely. So over the course of the 8-week program, so once we have the 3% roughly that are accepted, we're spending time primarily focused on getting two things, community and coaching for the founders. So to your question on the coaching piece, there's kind of concentric circles of, access for the founders. So first and foremost, it would be our staff on the ground, i.e. in the room with the founders as we work together. So we have a staff of about 23 full-time folks across the U.S. The vast majority of those folks are focused full-time during a residency on coaching those founders. So, for example, myself, I'm spending time over the course of that 8-week period, whiteboarding with founders, doing coaching sessions, really providing that sort of hands-on mentorship. In addition to that, we bring on visiting partners that are a part of each one of these residencies. So these are folks that are typically part-time in terms of their involvement, but they're usually exited founders who have found success kind of going from 0 to 1 as a technology entrepreneur. That continues to provide more diversity to the cohorts that we run in terms of different skill sets and kind of value add to the founders. And then, the kind of third concentric circle is the global nature of Antler and the peers that we have around the world. So if I have an investment, for instance, that's focused on, fintech that's based in the U.S. that has ambitions to grow to Central Europe, I have a network of folks across the world who can be supportive of that, who have various domain expertise. And then finally, we have over 1,000 folks that we turn as advisors, synonymous with being a mentor across the platform. So each one of our founders has access to this database of advisors who are corporate executives or prior founders or investors who are committed to supporting our founders at their stage. And they can be very useful in helping with usually particularly tactical things that the companies are working on. So it's a fairly robust network over time that we've built, but the access kind of evolves over time as you mature as companies through the platform.
Okay. Thank you.
Further questions?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council approve a commitment of up to $15 million to Antler U.S. New Mexico LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and paperwork.
Second. By Chair Bingaman, a second by Madam Treasurer. Any discussion on the motion before the council? Hearing none, let's take a roll call vote on this motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Lauren Montoya.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
Yes.
State in the affirmative, motion passes.
Okay, great. Thank you all.
Thank you all.
For this today.
Appreciate it.
All right, next we'll go to agenda item 4E, 4E.
For our second New Mexico investment. This one is a firm that we've known a while, since 2020. It's a group called ANZU that we've made commitments to. We made a $10 million commitment to their Fund 2 and a $15 million commitment to their Fund 3. They've made investments in a couple New Mexico businesses. They're the lead financial investor in NTX Bio. They've invested nearly the size of our commitment in that company. They led the Series A. The company raised a $47 million Series B last year. We're joined by one of the executives of NTX, who will speak to you. And ANZU continues to look for opportunities, not only from its companies that are headquartered here, but that companies would be looking to expand here. And there's a couple of examples. XGS Energy, which is a next generation geothermal company that's looking to expand here. Also joined by an executive of XGS today, as well as a pending life science investment. And so this fund is intended to provide follow-on capital for companies at a little later stage. Most of the investments we've made lately in the program have been at the inception or early stage. This is when companies have reached product market fit and are looking to scale. I wish we had more of them in New Mexico, but I think NTX is a good example of one that is a great success story that we would all like to see expand and scale here. I'll pass it along to Richard.
Thanks, Chris. Thanks, Madam Chair. I do want to mention, too, with NTX Bio, I mean, that's the case study of what we want to see in the New Mexico program, where we have a manager that's leading the Series A, helping the company get off the ground, and then it attracts outside capital into the state of New Mexico in multiples of what our commitment is. And so ANZU is doing exactly what we want to see in the New Mexico program. This fund itself is similar to the TCG Lab Ops Fund in that it's focused on later stage investments that the previous ANZU funds committed to. Most of the capital is expected to go into ANZU portfolio companies, although they may opportunistically target some other later stage companies that they know. I think one of the differentiators of ANZU compared to funds of similar size is the amount of resources that they have and the experienced investment team that they have. The investment team has 13 individuals who have operating and consulting backgrounds, with all three managing partners having worked at Boston Consulting Group at one point in their career. The firm also has a business services team that has over 40 people to assist portfolio companies on various services such as accounting, talent, marketing, publicity, intellectual property, and technical services. We've heard positive remarks from the portfolio company CEOs as we've talked to them about ANZU's involvement in that fund as well. So, this is another part of the New Mexico program that we like to emphasize. It's more than just the capital that they're investing, it's the value add that they can bring to the companies to help them raise that outside capital. So we're recommending an up to $20 million commitment to the fund. I'll turn it over to the ANZU team.
Good morning. It's really a pleasure to be here. My name is David Michael. I'm one of the co-founders and managing partners of ANZU Partners. On a personal note, I'll tell you that my favorite spot in the world is the mountains above Cimarron, New Mexico, at the Philmont Scout Ranch, where I've spent several summers. And we very much appreciate our partnership with the state of New Mexico and the potential investment from the Investment Council in the ANZU Tech Leaders Fund. As Richard described, the fund is designed to make later stage venture and growth capital investments into very technology intensive companies that often are derived from major research institutions, national labs, public universities, and that have proven themselves in their development process and along the way have typically already benefited from the participation of corporate investors and partners that are among the type of co-investors that we recruit as these companies develop in their journey. Part of our commitment to the state of New Mexico in this fund is to continue to both back existing New Mexico-based companies, such as NTX, and also to make efforts to bring innovations from other geographies and other companies into the development of New Mexico's economy generally. And XGS Energy and geothermal is a great example of that, and we'll hear a bit about that in a moment. The fund is designed to have a 3-year investment period. As Richard mentioned, some of these are investments in companies that are graduates of our early stage programs,
and others are new companies that we will recruit into the new portfolio. I do want to quickly introduce to you two of the executives from companies that are candidate companies for the portfolio. First, I'd like to introduce to you Dr. Rachel Gomez. Dr. Gomez is a native of Albuquerque, is an honors graduate of the University of New Mexico, and she went on to earn her PhD in biochemistry from Stanford University. We're delighted that through, in part, our support of NTX Bio, Dr. Gomez is able to return and now works as a research executive at NTX Bio in Rio Rancho. And then Dr. Lucy Durago, also a PhD, earned her PhD in chemistry from UC Berkeley and is a world's leading expert in energy resources and in the geology of geothermal. And although Dr. Durago is a Texan, she's spending a lot of time in New Mexico helping to develop projects for XGS Energy to harvest the tremendous geothermal energy resources that are existing here in the state. I might first invite my colleague David Selden to talk a bit more about the programs that we have in New Mexico, and then invite Dr. Gomez and Dr. Durago to make some comments.
Thank you, David. It's a pleasure to be here again. It's always a pleasure coming to Albuquerque and Santa Fe. I have the honor of being on the boards of directors of every one of our companies involved in New Mexico, NTX, XGS, who you'll hear from, and BioFlight. We're proud of all three of these companies. We think they have really strong trajectories. As it's been discussed, NTX was very fortunate. We were delighted to lead its first round and then participate strongly in the next round, where RA Capital came in and made a major investment. RA Capital, of course, one of the world's leading biopharma investments. Dr. Rachel Gomez is one of the smartest people across our whole portfolio, and I'm just proud to tell you that the work she's doing could affect any one of our lives in a very positive way, and she'll talk specifically about some of the work we're doing at NTX, which has blossomed very significantly over the past several years. In terms of the support that we offer for our portfolio companies, we've recruited the CEOs of both of these companies. In fact, all three, BioFlight, NTX, and XGS, have CEOs since our investment that we've recruited, and we work actively as board members in building those companies. BioFlight has a technology that the state is looking at for deployment as well. As you might recall, BioFlight has a real-time detecting system for biological attacks. But we've also extended that technology now to detect fentanyl, one of the most dangerous things around, and we've proven out that we can also detect Legionnaire's disease. So we're actively thinking about applications for that in public safety. So we're pleased at the end to answer any questions about our New Mexican companies. Among our partners, I'm the one who's closest to these companies, since I have the honor again of serving on each of their boards, and we're delighted that they're growing presences in the New Mexico market. Let me ask Rachel Gomez to talk a little bit now about her work at NTX.
So as has been mentioned, NTX is a biotechnology company. It's currently headquartered in Rio Rancho. It's spun out of Los Alamos National Labs. Spent some time in the labs of the Santa Fe Community College before moving to Rio Rancho in 2020. Most of our employees at the headquarters, including myself, are either trained in New Mexico University, native New Mexican, or both, and we prioritize recruiting from New Mexico when we can. The broad goal of the company is to advance the healthcare industry and support the growing demand of mRNA and protein-based therapeutics by revolutionizing the way these products are made. NTX has developed a biomanufacturing platform that we call NTX Thrive, and is in the midst of launching its first commercial product using this platform. The COVID-19 pandemic highlighted the United States vulnerabilities in response to, treatment, and prevention of biological threats. Since then, there have been major advances in scientific technology that have accelerated the development of countermeasures against pathogens, one such being the development of mRNA-based vaccines. mRNA is safe, effective, and cheaper to make than previous protein-based vaccines, and the FDA approval and wide use of mRNA-based vaccines vaccines out of Pfizer and Moderna really paved the way for future mRNA vaccines. In fact, there are some under development against Zika, Ebola, rabies, norovirus, and the flu. But there's still vulnerabilities in how these mRNA vaccines are made. They're currently made in a few centralized, large-scale manufacturing facilities. This leads to gaps and inefficiencies that can compromise the next pandemic response and readiness, and also expose inequities in access to life-saving products. One solution to these vulnerabilities is distributed manufacturing, meaning in the case of vaccines, a vaccine is manufactured close to its final customer, which would be citizens. Our product, NCX-Spread, can enable efficient distributed manufacturing. It's a benchtop. It can fit in a corner of this table system, but it also is scalable and is automated RNA production. It utilizes continuous flow, meaning RNA is produced in an uninterrupted process. As soon as the RNA is made, it's purified and ready to package into the delivery vehicle that's the final vaccine. This minimizes degradation, contamination, and the need for human intervention. It can fit into a portable manufacturing facility that one can imagine can be used in Mexico or across hospitals or emergency production facilities. We're also currently working with research hospitals across the country to enable scalable production of personalized medicine. There's many clinical trials right now where the testing will inform what medicine a patient needs. If we're able to produce that at the hospital where they're getting treatment, will enable patients to receive life-saving therapeutics when they're needed. So we're a technology company. We're with the goal of enabling development and manufacturing of multiple therapeutics. Our technology is agnostic to the particulars. And again, our goal is to enable more efficient production of a variety of life-changing therapeutics and biologics in New Mexico.
If I can add just two additions to what Rachel said. The system that she's talking about, the vision we have with major cancer centers, is the system would sit in the room with the patient. It would actually make the drug for that patient, which you can't ever do with the kind of system that currently makes mRNA. The second thing I mentioned is another important part of the company is the manufacture of key ingredients for mRNA vaccines. It probably doesn't surprise anybody in the room if I told you that key ingredients in mRNA vaccines made almost exclusively in one country, and that's an adversary nation. NCX has developed a program to enable that key ingredient to be made on U.S. soil, and we're actively engaged with the U.S. government on talking about a program to enable stockpiles of that, so that in a pandemic we would not be exposed to an adversary nation restricting our access to a key ingredient.
So are you working with the CDC at all, or not yet? Or is that part of the... I would say not yet, but that would be potentially part of the vision. Most of the communication has been with the federal government.
With Florida specifically.
And with Florida.
With Florida. It's the arm of the government focused on this exact problem. I'd like to introduce, as David mentioned, Dr. Durago. Our company, XGS, we think is, I use this word advisedly, uniquely capable of helping New Mexico exploit its geothermal resources. We're in a world of hyperscalers with almost insatiable demand for energy. We think linking XGS's technology with New Mexico's geology could be transformative in terms of new clean energy.
Thank you, and thank you for the time this morning. At XGS, we're proud to have developed a geothermal technology that makes it possible to develop geothermal anywhere there's hot rock, independent of impacting critical water resources. Technology is making it possible to scale geothermal multiple orders of magnitude relative to existing technologies, and geothermal only makes up less than 2% of our energy mix in the U.S. today. So the opportunity is immense. When we think about the impact geothermal projects can have, they invest significant capital and create long-term jobs, typically on the order of hundreds, if not thousands of jobs in their community. We see a gigawatt opportunity in New Mexico, and it matters where the energy goes to as well. When we think about what opportunities geothermal development can attract to the state, as David mentioned, opportunities like data centers, which rely on enormous volumes of firm, reliable, 24/7 energy. And increasingly are also prioritizing clean, carbon-free, or renewable energy, are looking to sites specifically where they can have access to that resource. As XGS, we're pre-commercial today. We're evaluating where our first commercial projects could be sited, and New Mexico has swiftly risen to the top of that list. Abundant, renewable hot rock resource, access to world-class universities and national labs, as well as a large and experienced subsurface engineering and operations resource or workforce, make New Mexico ideal for geothermal development. I'll highlight about 8,000 to 10,000 jobs in New Mexico today are associated with subsurface operations and can be leveraged in the growing geothermal industry. Ultimately, this next generation geothermal opportunity is here and is significant. We see New Mexico is poised to lead it, and we intend to be leading that opportunity in New Mexico. Thank you for the time.
Okay, great. We're going to go to questions from council then.
Madam Chair, this is Nick here.
Yes, I see Member Tejas has a question.
Yes, and I just wanted to share my thoughts and congratulations to our partners here and to the team at SIC to continue the partnership and working relationship with Anzu. As some of you know, I think we have some new members on our council, but I have a very close experience with Anzu, NTX Bio, as I was able to see at a ground floor level the growth from some technology and sort of tech transfer out of Los Alamos National Labs from a couple of the scientists that were original founding members who ended up working with Santa Fe Community College in our Innovation Center to do some of the research there at our college and work with our students to also include them in some of the learning opportunities there. From there, the Investment Council had made a placement to help raise some funds to start up efforts with NTX Bio, and they apparently were considering leaving New Mexico, but because of things, and I think it wasn't a small thing and a small commitment from the State Investment Council that encouraged them to stay in New Mexico and stay in Rio Rancho and set up shop there. And I'm just thrilled to see that there is that footprint in New Mexico, and it looks like their portfolio in our state is continuing to grow with what I hear on the geothermal side. So just commend everybody's work on this. I think it is really a case study for how some real successes can start from a very small initial level to being able to make something that is really more long-standing in the state. So thank you for that. I'm very much supportive of this, and Member Bingaman, if I can make the motion when.
No objection here.
All right, when we get to that point, we will call on you, Member Tejas, and remember, you have to read it fully. You can't just say so moved. But, for the question. All right. I want you to disclose, and I don't think it conflicts me out, but that we have sat down with XGS. I just want to say, I'm so excited you're from New Mexico, and you're a rock star. All right, yeah. Thank you for being here with us, folks. All right, we're going to go to Member Tejas for a motion.
So, Madam Chair, based on the recommendation of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight from RVK, I move that the State Investment Council approve a commitment of up to $20 million to Anzu North America Tech Leaders Fund LP, subject to and contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiations of final terms and conditions, and completion of appropriate paperwork.
regarding the no step down in fees, was there a reason we did that differently for this deal?
So that's the way that they structured it. So, I mean, it's always contingent on legal review, the recommendation, and so, during the legal process, there can be further discussions about that, but that's the way that they've structured it.
Okay. Any further discussion? All right. Any further discussion? Hearing none, we'll take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
Nick Teas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
yes,
8 in the affirmative, motion passes.
Great, thank you so much, and thank you all for being here. So we've got one more item from Director Cassidy, which is a commitment clarification agenda item for
The final thing is just a clarification on a motion last month. The incorrect amount made it into the motion. The motion said 60 rather than 65, so we're just attempting to clean that up.
We have to make a new motion and take another vote? Yes.
Based on last month's recommendation of the Council Investment Committee, private equity consultant Mercer, SIC staff, and the general fiduciary oversight of RBK, after the Fiscal Investment Council approved a commitment budget of $65 million to Builders BC Fund 3 LP, as stated in the original September meeting materials, subject to assumption upon the Mexico legal requirements, Mexico State Investment Council policies, negotiations, and terms and conditions, and completion of appropriate.
Second. Got a proper motion and a second. Any discussion on the motion? Hearing none, let's take a roll call vote.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
Nick Teas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
yes.
That's 8 in the affirmative, motion passes.
Who caught that? Nobody caught that. Congrats to whoever did. All right, now we're gonna hear from, Officer Iglesias? Officer.
Thank you, Madam Chair, members of the committee. I have one operational item for you, this morning. The real estate structure study that you all approved last month now needs subsequent changes to the investment policy statement. So several of our private asset classes have their own individual investment policy statement. You've already approved all of these changes last month. This is simply codifying it in the policy statement. The primary changes were changing the ranges to core and non-core real estate, as well as changing the benchmark. That's reflected here. I'm happy to go through item by item, but since this is just an update, I will leave it to any questions. If you would like me to review the individual changes in the document, happy to do so.
Is there a requirement for her to go through item by item? Okay, there are questions, so let's go to questions. Madam Chair, on the first page, 298, when you say and other select permanent endowment trust funds under SIC management, what does that include? Does that include also like retiree healthcare, or housing?
No, that's going to be other funds that we directly manage. So say Water Trust Fund, rural libraries, there's several funds. So instead of listing them all out individually and also having to update the investment policy every time real estate is added to an individual fund, this is just clarifying that there are other funds than just land grant and severance in which we have real estate allocated.
And Madam Chair, I assumed that, but the way I read it doesn't necessarily state that. That says all funds under SIC management, so those funds are also under SIC management even within the joint powers agreement. So I just thought maybe there could be some better clarity on that, because that would be overstepping those other funds.
Madam Chair, Treasurer Montoya, it does say other select permanent funds. The idea with the other select being those that have it allocated. If you would like a clarification, I'm sure we could
You could say non-client, but it's sort of pejorative because beneficiaries, but also I think the keyword is permanent because the client funds are not necessarily permanent. I'm not looking at the language with what I just heard. I think permanent addresses your concern because client accounts, they invest in our pools. They're not permanently with us. They're not also not permanent funds under the New Mexico Constitution or the legislative statutory.
Madam Chair, all of the ones that, like retiree healthcare, Los Alamos, none of those would be considered just because of the word permanent?
I would say yes.
And then, Madam Chair, on page 2, I noticed, so you have core, we changed it to 25 to 50%, but then it has core plus, but it didn't have the line the rest of the way. So is that part of the 25 to 50%? So you're putting it as a whole? And then value added, there's nothing in that whole, so are we saying that's 50 to 75% with opportunistic?
With, Madam Chair, Treasurer Montoya, value add, opportunistic, and the REIT option are all within that 50 to 75%. The core and core plus are within the 25 to 50%. And this is just sticking with the same structure of the existing policy. So simply changing the ranges, which was updated in the structure study. The policy and the structure of the policy here in this, the way it's outlined hasn't changed.
And Madam Chair, on the real estate investment trust, that's less than 10%, correct?
That is correct.
I think we need to add that in there.
It says at the last bullet point.
I saw that, but for consistency, you have the percentages on the right-hand side. So that would have, the percentage on that one would go to the right-hand side as well.
Madam Chair, the way that this table is structured is that the 50 to 75 is value add, opportunistic, and REIT should all be within the 50 to 75% range, but that the real estate investment trust specifically is limited to only 10%.
Oh, that 50 to 75%. And then, Madam Chair, on the next page, I needed a little bit of understanding. It says, in general, the core, first paragraph, and core plus exposure on the one hand, and the value added and opportunistic components on the other hand, will be monitored and balanced by the State Investment Office based upon a variety of risk factors in the portfolio, recognizing blah, blah, blah. So are you changing it from the council to the office? Or is that the way it was always been?
Madam Chair, Treasurer Montoya, that's the way that it has been in terms of the office is able to balance between the ranges. So the policy states the 25 to 50% for core, the 50 to 75% for non-core. It's the office who's going to balance where we are within those ranges, but it's the board that sets that policy. So this is just addressing that balance between where those ranges and how the investment asset class team will target where we are within those ranges.
Okay. And then on performance benchmarks, we added plus 75 basis points. That's a lot. What was the logic behind that part?
Madam Chair, Treasurer Montoya, the 75 basis points was to account for the additional risk in the portfolio. So by shifting from core focus to more of a non-core focus, the Odyssey Index is really a core benchmark. And so to reflect that additional risk that the total portfolio is taking, the asset class team and approved by the board last month was that an additional premium be added to that index so that we try to meet that and account for the skew towards non-core in the portfolio that's being.
Madam Chair, that leads me to my question about core plus and core, because they are different benchmarks, so they have different outlooks overall. Is it in the best interest to combine them in the percentage, or is it better to break it out so that you can have a clear benchmark for each one of those?
Madam Chair, Treasurer Montoya, I think for this I'll defer to Townsend, if you don't mind.
I'm happy to come up. I think the challenge with the core plus, and the value add opportunistic is that the industry definitions are not real clear. Where the line is drawn between those is not real clear. And strategies can morph over time as well. So a core plus fund rather, can have a very core-like composition, even though it's categorized as a core plus fund. So we recommended, the construct at the policy level would be core versus non-core. And then in each one of those categories, you've got these subcategories that are probably best left managed on an ongoing basis by the investment staff. We will obviously report the level of exposure to each one of those in all of our reporting to you, so you can monitor it yourself. But in terms of making specific allocations to each one of those subsectors, core, core plus, value add, opportunistic, in a private market asset class, it's just difficult to manage to that many ranges, if you will, or that many targets, if you will.
So, Madam Chair, when you put 75 basis points, do you have an example of what that looks like? 75 basis points, especially when you're talking about the amount of money that we're dealing with, that's a humongous threshold.
It's a material premium, and we had in the structure study a number of different ways of looking at what's an appropriate premium for a risk profile that we're expressing in your policy. And we based that premium on a survey of other investors like you, permanent funds as well as pension funds. We did some back testing analysis of historical returns and looked at, with similar risk profiles, what would be the typical premium over core for a portfolio that is skewed towards more non-core investing. And then we have our own assumptions going forward in our asset allocation work, our capital markets assumptions. So based on all three of those factors, we kind of triangulated it on a 75 basis point premium.
Isn't a higher premium mean that it's sort of stricter or harder to attain, or?
Oh, absolutely.
It's going to keep us,
it'll be harder to hit that, but we would expect you to, if you're taking the risk, we would expect you to be compensated for the risk. And that's where the 75 basis points seems to be about the right level. And that's a benchmark that is measured over 5-year periods. It's going to take a little bit of time because your portfolio is going to be skewed towards a lot of non-core investing with J-curve. So we would expect for a few years, you might have some struggles with that. That'll drag down the numbers. But generally speaking, we think that's an appropriate level of premium for your risk profile.
Rob, can you just stay put until we're done?
Yeah, absolutely.
Thank you. Further questions? We have a motion.
Chair, based on the recommendations of the Council Investment Committee, SIC staff, and General Fiduciary Oversight from RBK, I move that the State Investment Council incorporate into its real estate investment policy statement updates previously approved by the Council reflecting last month's real estate structure study as memorialized and discussed by the Council today.
Second.
Okay, we've got a motion by Member Bingham and second by Member Tejas. Any discussion on the motion before the Council? Hearing none, if we can take a roll call vote on the motion.
Commissioner Stephanie Garcia Richard.
Yes.
Treasurer Laura Montoya.
Yes.
Nick Tejas.
Yes.
Catherine Allen.
Yes.
Don Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
In the affirmative, motion passes.
Thank you, Don. Thank you for your.
Okay.
Thank you. All right, next we're going to hear from our governance committee, and I will turn it over to Chair Allen.
Thank you very much, Madam Chair. We have been meeting on a regular basis. There has been positive feedback regarding the breadth and depth of the educational interests. I know that John Clark talked to a number of you and came up with great ideas. There's an extensive list, and we will share that with you. It takes too much time to go over right now, but let's just say it was a great effort. I will be meeting with the new Risk Performance Officer, Nino Carpenito, and John to incorporate risk into more of our discussions and also to come up with a risk matrix for us. John also outlined the time frame for the potential implementation of the investment policy statement. It would be done in 2025. The first quarter, there would be no changes. Second quarter, the council would approve the larger half of the investment policy. There would be no meeting in July, and then the full implementation would come about in August. That's primarily what we did at the last meeting. We look forward to talking about this in November, hopefully to vote on it at the offsite on December the 2nd and 3rd. And I just want to encourage everybody to come to the offsite because it's really going to be a critical time for all of us, both on voting some issues, but also in understanding and addressing some of the educational interest areas that we have. That's all I have, Madam Chairman.
Questions for the chair?
Madam Chair. So Member Allen, what will we be voting on in November, December?
Hopefully the investment policy. The changes to the investment policy.
So the entire investment policy.
And our state investment officer, Clark, has more information on that.
Thank you, Madam Chair and Member Tate. So, in this case, the governance committee met and discussed this prior to the investment committee meeting and discussing it. We did receive a lot of constructive feedback from the investment committee related to the investment policy statement. So we do have some more work to do to go back and make some changes. I think we're just going to have to see whether the timing works to have a vote on it at the retreat or not. We don't want to force timing if we're not able to get it to a point where members feel comfortable with it. So that's kind of been the internal target, but at this point, we still have some more work to do on our end on the investment policy statement. We're going to be bringing it back before both the governance and investment committees again in November, and we'll just evaluate at that point and see where we stand.
Yeah, so Madam Chair, I thought that at the November meeting and the offsite would be a discussion more related to our strategic planning. And so, you know, a lot of the issues, even in the investment policy statement, as well as some operational issues, to me just seem like they would go very well in a strategic plan. And in that strategic plan, you would have a timeline of when things get implemented and things like that. So I guess another question would be, what are we looking at in terms of what would we be trying to address in our strategic plan?
So, Madam Chair, sorry, Member Allen. So when I asked each of the members what they would like to see in the at that offsite retreat, there were four things that really repeatedly came up. One was discussing staffing and compensation and the compensation report by McLaughlin that will be finished in advance of that. The second is the structure of the organization, including specifically what should the council be doing, what should the internal professional team be doing. Another was a discussion about the New Mexico program, and another was a discussion about risk. As you'll see, if you take a look on pages 310, 311, 312 of diligent, I listed out here all of the great suggestions from members on educational items. There are a number of items related to risk. In conversation with the moderator that we've hired to lead the council through the strategic planning discussions, she has decades of experience, not just as a moderator, but as a moderator for strategic plans. She determined we just are not going to have enough time to cover risk, cover a couple of other topics we were going to have, and suggested that we leave that reforming the mission statement and goals for the organization, discussing the structure, and that involves presentation by Dr. Ashley Monk of best practices and models that are used in the industry, discussion of compensation and bringing in presentation from McLaughlin, and then we're still hoping, if time permits, to have a discussion about the New Mexico program, because that's such a key component of what we do as an organization. But at this point, our moderator determined we don't really have time for anything else, and that is already a very packed schedule.
I would care more about risk as a retreat than the New Mexico Fund, because we're already very familiar with it. We already know what's going on with it and why. But you guys are trying to make as many changes of taking away the authority of the SIC and putting it in the hands of staff, then risk needs to be a conversation that's discussed within that, I think. That's just
Yeah, I would really agree with that. And I just wanted to share with the council that, you know, as a part of our 2024 audit for the State Investment Council funds that we manage, we do have an audit committee, and you know, I sit as the chair of that, and so the auditors, you know, regularly will meet with me to discuss the status of the audit and issues, and we discussed the risks associated with the idea of making these changes to the investment policy and making a big change, which is you know, which we can't really sugarcoat that this would be a very big change for the council. And the auditor did sort of voice their concern, at least in terms of risk associated with staffing and capacity of the management as it sits today. And so they just, you know, in discussing this subject, they urged me to communicate with the council about making sure that the staff is set up for success and making sure that we have adequate capacity with the current operations. I mean, I know very well that things within staff have been over the years very, very lean. And so, you know, on the one hand, staff has been able to develop all the, you know, all of the documentation and prep for the meetings. And so I think the capacity is there, but we got to make sure that we are 100% confident that there is that capacity, especially in the accounting area. I do know for a fact, because we talked about it on the audit committee a lot, that the accounting area is pretty lean. And again, the auditors kind of mentioned that to me as well. So I don't know where we talk about this stuff, but you know, if we have the opportunity at the offsite retreat to really have a very meaningful conversation about this kind of thing, you know, I think it'd be really important for us as we consider making this change to our policy. And then on top of that, you know, how are we going to have proper internal controls and risk assessment and be able to still have oversight and governance on you know, large amounts of, you know, what are coming up to, I mean, we approved how many, maybe close to $1 billion today in investments. One was at least 300 million. And so, you know, to have everybody have the comfort level with that being handled outside of the public discourse, you know, is really important for me. So,
Member Tim, could you just clarify when you say capacity, do you mean increased FTE?
I think so. I think we would need to talk with the staff and really see, you know, what that looks like. But I mean, as I am a outside observer, you know, our accounting operation is one CFO and I believe a couple of accountants and maybe some other financial folks in there. Is Brent on the call?
Yes, and I don't know, I don't mean to put you on the spot, but I'm wondering if you could share.
It's me. I'm an assistant. There's currently an investment accounting manager and 2 analysts. We're currently recruiting for a 3rd analyst. So on the investment accounting side, it'd be 4 to 5 people. And we are focused on recruiting, but as everyone knows, this market's kind of tough. We thought we had someone, ended up not working out. So I can definitely understand Member Tejas' comments.
he and I had discussions on this. I couldn't push back really hard. A good way of looking at it, I think when I started here 12, 13 years ago, we had $14.5 billion, same type of staffing levels now that we have now. Now we're up to $60 billion. I would just point out to everybody, name me one entity with $60 billion in assets that basically have 30 people, not even 30 active employees. It's kind of unheard of. So from that point of view, I can understand the auditors having concerns, both from the accounting side and the investment side. So I think that's what Nick's trying to say more than anything else.
Yeah.
And then I have a question number two.
Uh-huh.
Do the auditors, are they aware about our consideration of a change in how we approve investments? Do they know about that?
Yeah, I did talk to them about it in all of this. We did talk about that subject, but originally they had scheduled a meeting with me to talk about the 2024 audit because that's coming up due in November. But at the same time, we did discuss this change in the, possible change in the policy and what that would look like from their perspective, because, they do very rigorous auditing of our funds, and we have even the agreed upon procedures. And so, it's really important that they do weigh in on how they see it. And what they told me, the biggest concern is just staffing capacity on, making sure that that is in place. And then also they mentioned a succession plan as well. Brent, we hope you stay with us forever until you're until the very end. But, I don't know how likely that is. And I know you've been doing this a long time. So succession planning is really important. I think that's another thing that could go into a strategic plan. But, I know that Mr. John Clark has under the topics here for category 1 for the SIC 2024 educational item request and framework. Under category 1, we are set to discuss organizational chart and then, successful endowments and how they staff up those endowments. So, I think we're on the right track. It's just, from my perspective on the audit committee, want to highlight the importance of really making sure we are doing everything we can to set everybody up for success and, avoid any kind of, on something that goes under the radar with making it such a large change like this. Does that help, Madam Chair?
Absolutely. I very much appreciate that input, and just kind of based on that, with all due respect, staffing is your purview. We are not responsible for that except for hiring you. But I think hearing that our auditors have some concerns.
So Madam Chair, we do plan to spend a pretty significant portion of the time of the retreat talking about exactly that, because I think ensuring that there is proper staffing should be a matter of concern for the council. So we are setting aside quite a bit of time for that, as well as to talk about checks and balances and protocols and everything else that Member Hayes just mentioned. The discussion of the New Mexico program is slated essentially for the last 2 hours of the second day, and if the other discussions go long, then we'll mix that and we'll have that discussion another time, because that other stuff is more important. So, but we recognize that, and we're trying to be cognizant, and we'll just play it by ear whether there's time to have a presentation at that point on the New Mexico program, or if this other stuff really takes up all of that time, and that means to just.
So I would just encourage you, and I'm just going to echo, the treasurer's suggestion that we swap out New Mexico program for a discussion on this.
And Madam Chair, so I would like to very quickly cover the educational items that were requested by members. You'll see there are a lot of items related to risk. We have days, if not a whole week's worth of discussions to have about risk. There are a slew of items related to investment risk, and then a different slew of items related to organizational risk. So one thing that Risk Officer Nino and I are working on is putting together what a slated schedule council as a whole, and, we'll come back with those proposals. The question would be, what could we cover in 2 hours? And I think there are so many risk-related items listed here in the 3 pages of requests by members. It's hard to adequately cover that in 2 hours.
That's understandable, but I'm just wondering if we could consider, spending time on risk, even if it is just 2 hours, even if it is just a small bite of the apple, rather than in New Mexico.
Madam Chair, if the council would like to do that, we're happy to.
It's your decision, you're the one making the agenda, so. No, actually, it's our decision.
It is your retreat.
I mean, people give their requests, and then the agenda is made. So, there's no council action on what the agenda is. The retreat is for the council saying what they want to hear about. I mean, are folks interested in risk rather than the New Mexico program, or would you prefer, what's the preference?
Madam Chair, this is Kurt. I think risk is important. It's a big component of these changes. I believe that staffing is a real big component as well. I echo Nick's comments about the size of the fund and making sure that it's adequately staffed. I think that our oversight objectives as a committee is and our obligation from a fiduciary perspective is important to delve into those in great detail. So from my perspective, risk and staffing are a big component of this change that we are proposing, and making sure that there are adequate safeguards to make sure that the work is done appropriately with adequate staffing. So I echo the same view that you all are sharing.
I agree with that as well. If we need to move off the New Mexico program, probably important.
Madam Chair, members, unless there's any dissent, I'm happy to go with the wishes of the council and replace the New Mexico program discussion with the discussion on this.
Further on this item. Yep.
And then, sorry, I do want to just very briefly, thank council members for providing all of the suggestions for these educational items. It would be great if everyone could go through and go through them. It's 3 pages, but we got a lot of great suggestions. I think there's a lot of stuff that we'll need to figure out how to go through both in the committees and the council, but really appreciate the feedback that we have. So thank you.
Anything further? All right, great. We thank the governance committee. We thank Officer Clark. Okay, with that, we'll go on to hear from our CFO.
Just a couple of comments, and shouldn't take long. I just wanted to notify the council that I wasn't sure when the timing would actually occur, but there is a bar that we submitted to VFA that's in progress. We probably will hear about that in the next few weeks, I would hope. And again, I wanted to emphasize the primary reason that we did this bar is for the additional 6 positions that we were authorized for this fiscal year. There was no funding for that, so we had to get the funding for that. And then because of the asset growth that we've had over the last several months, I went ahead and did some additional bar dollars for the investment management fees, make sure that we made it through the end of the fiscal year. It's a situation because we have over 25 public mandates that you want to make sure that you have plenty of bar. You don't want to get to a point where you don't have the capacity to actually honor the contracts that we have out there. And then within the investment holdings report for this month, this is September's investment holdings report. I wanted to emphasize to everyone that not only are you seeing monthly activity, but because the report falls on a quarter, you're also seeing quarterly activity. Just remember, depending upon whether you're looking at monthly activity or quarterly activity, the starting point is a little bit different when you're reviewing that. And then audit status, I just wanted to let everybody know, I think the audit is progressing well, and we're actually working on draft financial statements right now, and I just want to give a shout out to all the people on the accounting staff really working hard. We lost an investment accounting manager at the beginning of the audit, and someone stepped into that role internally, and she's doing a fine job, and I really appreciate that. And then lastly, I completed the schedule. I did not include it in the material, which I apologize for, but I think there was an approval of new contracts being reported to the council greater than $250,000. And I just wanted to let everybody know for the quarter ended September 30th, we had 2 contracts, one for Invent, who does the private funds data monitoring and capital call and distribution processing. Estimated annual amount is $350,000, and that's over 4 years. And it's billed on a number of funds, and I'll include this schedule next month. And then also we renewed the contract for Parametric. Parametric is the service that we use for the beta overlay portfolios, and the contract for that is about estimated at $850,000 for the year. It's based upon assets under management. And again, I apologize, I was meaning to include that in the material, but we'll have to wait until next month, but I'm giving everybody at least a verbal communication right now. Other than that, I'm happy to entertain any questions that you might have.
How much is the bar?
I knew you were going to ask that. You know what? I don't have the exact numbers. I can tell you in the 200s, I think it's 900,000 plus, and within the 300s, I believe it's $3.5 to $4.5 million.
And I think, Madam Chair, you had educated me last year, bar is sort of open-ended in your guys' realm. Different.
Madam Chair, Treasurer, I believe there's language within House Bill 2 that gives us a lot of flexibility as far as management fees are concerned, and it is pretty much open-ended on that. So generally, and I think this has been the case with all the sessions I've dealt with, they're usually pretty good about making sure that we have all the dollars we need in the 300 categories. The 200 categories a little bit harder. That's why we ran into the session and, you know, was a little disappointed that we didn't get the funding last year. I think John has really been focused on making some improvements in this area, and I think John is really focused on increasing our staffing levels. I want everybody to know, since he's been here, I think things have worked a little bit better. I think there's more communication between us and the executive and the legislature, and I just think there's more flexibility than we've ever had in the past. We tried in the past to make changes and couldn't always get the dollars that we needed. I think John is helping in this area, and yeah, we're up to potentially up to 37 maybe by the end of this fiscal year. What the number should be, probably much higher than their 37 based upon $60 billion in investments, and this is just something John and the rest of the team is going to have to continue to focus on and make improvements in.
Madam Chair, on the increase on the 200, I know usually they get pretty upset about using salaries off of a bar, but in your guys' case, they allow it. So even though they gave the 6 position, they didn't give you any more money. So next year, when those 6 positions are already solidified, are they is the idea that you put it in your budget for the 200s, or do you still have to pull out of the bar?
Madam Chair, Treasurer Montoya, we are anticipating that the going is going to be much smoother after this session. We did request funding for the additional 6 positions, and based upon the input that we got during the hearing that we recently had, and I think John can speak to this, I think it was received very well. Whether or not we actually get it, I don't know. If we have to go in for a bar for 2 or 3 positions, assuming they maybe fund half, we'll just have to do that going forward. But staffing, is very important, and it's kind of weird. I think the legislators have always been more open to providing more than enough on the management fee side, a little bit stingier with the 200s. I think we need to basically continue to communicate with them and educate them on what we need as far as staffing. And as I've said throughout the years, and John knows this, and I think he's well aware of it, if you want additional positions, additional funding, you got to use what you have. So a good starting point for going forward is to fill the positions that have been authorized and barred for. So when we go forward in the future and ask for additional positions, we're successful in that regard.
Madam Chair, the 300s right now, for yesterday, but I can't find it. It's about 8 million in the 300 category.
No, the
or how much is it?
oh,
I know it was mostly encumbered. That's why I saw it. I find it.
hold 1 second, I'll find it for you.
And then while you're doing that, just one question to John, Madam Chair, how often do you meet with the executive?
Madam Chair, Treasurer, it varies, but I try to do it on a roughly monthly basis.
Right.
It is obviously more difficult this time of year, especially with election.
Treasurer Montoya, to your question, the 300 budget for this fiscal year is $65 million. So we're increasing it $3.5 to $4.5 million over what you're seeing here for the bar. And again, I think I emphasized this last time. One of the reasons that we thought it was necessary to go ahead and increase the bar in the 300 categories due to the fact that I put up the initial purchase orders for all the mandates we have on the public side. And we just don't have a lot of wiggle room to get us through the end of the fiscal year. And that's just based upon the initial purchase orders that I put up. So because of that, we have concerns making it through the year. And I guess depending upon where the assets end up, we could potentially have to do another bar before the end of the fiscal year, but I think we'll be probably okay going to the end of the fiscal year.
Madam Chair, I did notice that on that spreadsheet last night. I must have pulled it, but you're already at 61 million encumbered off of the fees that you're expecting for this fiscal year, so that was what I was asking. And then the last comment I would make, well, one more question, John, Madam Chair. How often do you meet with council members?
Madam Chair and Treasurer, I've been trying to do that on a every month or two basis as well. It varies, and lately I've been diving more into internal office stuff, so it's taking me back a little bit. But my goal is to continue a practice ongoing of trying to meet with council members personally every month.
And then the last comment I would make, just to remind the council, if you look at page 15 and 378, SIC is also very busy with seeing all of these people on this list that we don't ever go over, but they do help a lot of other schools and local governments and Mexico housing a portion of their pool. So I wanted to point that out. All right, thank you very much. Further questions? Hearing none, we're going to go on to agenda item 7. Any old or new business before the council? The Southwest Institutional Forum is here today and tomorrow. I know that Vince is speaking, a couple people from ERB are speaking, maybe Tara, but all the basic nurse in the financial world of the state of New Mexico will all be together today and tomorrow.
Thank you, Madam Treasurer, for raising that. This conference provider does this all over the country, and they divide the country geographically to put on these conferences. The only one we had access to was up in Denver. I went to that for a number of years. Then they broke the Southwest out, so you talked about us and Arizona, and put it in Phoenix. And they invited me to come over the first year, and I said, nah, I'd like to go to Denver. Second year, they really put the full court press on to come out to Phoenix one. So I did, and the attendance wasn't very good. We started talking to them about bringing it here to Santa Fe. They did several years ago, around COVID time. We've had that conference here, I think this is the fourth
All right, reminder that the next SIC meeting will be November 26th. Okay. Here. Mr. Woolman, was there anyone that signed up for public comment?
Madam Chair, I don't believe so. No one, we had one, that was going to dial in, request of the treasurer, but I don't believe that, we got subsequent notice from them that they probably are going to get.
With that, we, ask for adjournment, objection to adjournment?